Assalamu alaikum. Good evening, everyone. This is our second session of fixed asset accounting. In our first session, we covered International Accounting Standard 16, Introduction 1. In this session, we will cover International Accounting Standard 20, Government Grants, International Accounting Standard 23, Borrowing Cost, International Accounting Standard 36, and International Accounting Standard 40, Investment Property, and very briefly, International Accounting Standard 38. So this will cover substantially the area of the fixed asset within international financial reporting standards. So I'll be informing you about when you can ask the question. Instead of start writing while I'm discussing, it is better when I say, okay, start writing your question, then you should write. So this will be easier for us to manage those questions, and this way it will be easy for us to answer most of your questions. So first of all, reset the camera. So let us just bear with us for a few minutes. We're fixing the audio issue. Use new hardware. Use new hardware. Okay. So we start with international. Handouts are attached here, and you can download these handouts from go to webinar. Go to a webinar window, please. Handouts are attached in the go to webinar window. Please download your handouts so that those should be in front of you as a reference. International Accounting Standard 20, Accounting for Government Grant and Disclosure of Government Assistance. Scope of this standard is, this standard does not deal with government assistance that is prohibited in the form of benefits in determining the taxable income or taxable loss. Examples of such benefits are income tax holidays, investment tax credits, accelerated depreciation allowances, and reduced income tax rates. These are the examples. So this standard will not deal with tax breaks. Second, government participation in the ownership of the entity, government grants covered by International Accounting Standard 41, Agriculture. And lastly, accounting of government grants in financial statements reflecting the effects of changing prices. Then there are a few definitions. These definitions are very important. And once we go through these definitions, I'll be explaining some of the important concepts so that are important in understanding of this standard. First is government agencies and similar bodies, whether local, national or international. Then is the definition of government assistance, action by government designed to provide an economic benefit specific to an entity or a range of entities qualifying under certain criteria. Government grants. This definition is important. Assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. They exclude those forms of government assistance which cannot reasonably have a value placed upon them, and transaction with government which cannot be distinguished from the normal trading transactions of the entity. So let's see few examples, especially which apparently seems government grants, government assistance, but that will not be covered under International Accounting Standard 20. Examples of assistance that cannot reasonably have a value placed upon them are: number one, free technical, I think I can use pen from here, pen, free technical advice. If government provide you free technical advice. Second is free marketing advice and the provision of guarantees. Another example is where that assistance cannot be treated as a government grant is when the government buy from the organizations goods or services. So there it is difficult to distinguish it from the normal trading transaction of the entity. So this is also not treated as a government grant. Further, in this standard, government assistance does not include the provision of infrastructure by improvement to the general transport and communication network and the supply of improved facilities such as irrigation or water reticulation, which is available on an ongoing indeterminate basis for the benefit of the entire locality. Further, definition: grants related to assets. So I think I'll have to change my pen mode. So okay. Grants related to assets. Government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire non-current assets. Subsidiary conditions may also be attached, restricting the type or location of the asset or the period during which they are to be acquired or held. Then is the definition: government grants related to income. Government grants other than those related to assets. Very simple definition. This means if a grant is not related to the asset, then this will be treated as a grant related to the income. For givable loans for which the lender, in this case, this will be the government, undertakes to waive repayment under certain prescribed conditions. And then there is the definition of the fair value. So these are the definition of the government grant. Okay, so how will the receipt of government assistance affect the financial statement? Recognition: an entity should not recognize government grants until it has reasonable assurance that the entity will comply with all conditions attached to the grant. The entity will actually receive the grant. These two conditions must be fulfilled before recognizing any government grant. Then there are certain points to be noted. Number one, even if the grant has been received, this does not prove that the conditions attached to it have been or will be fulfilled. See, these two conditions are: the entity will comply with any conditions and will actually receive the grant. If you have already received the grant, this does not prove that the conditions attached to it have been or will be fulfilled. Next is
corners that people can see you on boxy corner right across the
number 2. It makes no difference in the treatment of the grant, whether it is received in cash or given as a reduction in liability to government. That is, the manner of receipt is irrelevant. This is second point. Third point is, any related contingency should be recognized under IAS 37 provisions, contingent liabilities and contingent assets once the grant has been recognized. In the case of a forgivable loan from government, it should be treated in the same way as a government grant when it is reasonably assured that the entity will meet the relevant items for forgiveness. If you people have any question related to the matter we discussed so far, so please feel free to ask. Meanwhile, I can continue with my lecture. Accounting treatment of government grants. International Accounting Standard 20 requires grants to be recognized as income over the relevant period to match them with related cost which they have been received to compensate. Okay.
There are a few questions. Let's begin with them one by one. Okay, Muhammad Amin is saying, please explain point A, examples under scope of IAS 20.
Under scope, okay, fine. Mr. Amin, this is the point. See, Mr. Amin, government assistance that is provided for an entity in the form of benefits that are available in determining taxable profit or tax loss or are determined or limited on the basis of income tax liability. So this standard does not deal with that. Examples of such benefits are income tax holidays, investment tax credits, accelerated depreciation allowances, and reduced income tax rates. Mr. Amin, I hope it should be clear. Any other question?
The next one is Vinash asking the same question. I merely listed point number 1 in scope of IAS 20. Have we done that?
Yes.
Muhammad Awais wants to receive these handouts through email as well. Alright, let me make this announcement first. In your go to webinar dialog box, there is a section that says handouts, and 5 handouts have been uploaded. I'm in the process of emailing them to you as well, so in case you're finding it difficult to download handouts from here, you will receive them in your email in about 5 minutes. Just as the question answer session is over. Shayan Ahmed Qureshi is saying, what about the situation if entity collects revenue on behalf of government, keeps its service charges along with the expenses incurred over and above the amount of service charges?
Can you repeat the question?
Shayan Ahmed Qureshi is saying, what about the situation where if an entity collects revenue on behalf of the government, keeps its own service charges along with the expenses incurred over and above the amount of of service charges?
See, if you collect something on behalf of the government, that is your liability that need to be paid to the government. But if government is paying you a portion of that receipt as a service charges, so this is not again a government grant.
The next is Abdullah Al-Sabahi is asking lands grants to water and electricity distribution companies only to use for building stations. This cannot sell the land plots or do anything else with it. What is the accounting treatment?
So that will be treated as a government grant.
That's a government.
Yes.
Nuza is asking, what about forgivable loan? Nuza Al-Rayami.
Nusa, if I am pronouncing it correctly, so if government has given you a loan and at a very low rate, for example, market rate is 10% and you have been given a loan at 2%, so there is a benefit of 8%. So you will treat that benefit in accordance with ISA 20, as we will discuss.
Okay. Qasim Iqbal is asking, please explain part B of remember headings.
Part B, okay. It makes no difference in the treatment of the grant, whether it is received in cash or given as a reduction in a liability to government. That is, the manner of the receipt is irrelevant. See, there is a general principle. If you avoid an outflow of cash, this is normally treated as equivalent to inflow of cash. So if you have a liability towards the government in the form of a loan, and as a result of adoption of certain operating practices, government says, okay, we will waive off your loan if you operate in a particular manner. So this will be treated as a government grant, though you have not actually received that money, but in fact your outflow is avoided. So this will be treated as an inflow for you.
Salman Munir is asking, please give examples and illustrations related to grant and assistance recognition.
See, examples we'll be discussing these examples. So if you do not find any specific example, I can answer that.
Mara Liaquat is saying, reduction in liability by government, is it included as credits given by government?
Yes.
Okay. Muhammad Hassan is saying, we can't listen. I hope the issue is resolved. Rizwan Shahzad is saying, are we not covering IAS 16 in this session?
We have covered that standard in very detail.
And the recording is
available in the last session, and the recording is available in vimeo.com.
Okay, just a few more questions before we move on. Then Muhammad Bilal is saying, could you please send me an Excel training content of level 1 to 1? Sorry, this is not an Excel training, but Bilal, let me see what I can do. Shayan Ahmed is saying, tax exemption for CPI do not qualify for IAS 21?
Yes, do not qualify.
For IAS 20?
Yes, for IAS 20 it does not.
It doesn't qualify. Nuza is saying, for pension fund, the Ministry of Finance support the pension fund with deficit accrual every year. So can we recognize this as government grant?
Yes, that can be recognized. But that is, hold on, what is the question?
The question is, Nuza Rayami's question is,
yes.
the pension fund,
okay,
saying the Ministry of Finance support the pension fund with deficit accrual every year, so we can recognize this as government grant.
Yes, we can.
Rashid Haneem is saying, why the government normally give grant to entities?
In order to support them, if they want to promote a particular practice in the production, so they can extend their grant. For example, if they want companies to operate in an environmentally friendly manner, so of course they will have to support the companies to adopt that particular practice, so that they are motivated to do that. Likewise, sometimes government want them to be more competitive in the international market, so that more foreign reserves can be collected. So they can provide them the grant so that they can update themselves, they can update their machinery in order to align themselves with the international producers. So there could be many reasons. Okay, let's move further.
There are more questions, but if you think
Yes, we can then maybe a few of them will be answered
as we go along.
Okay. Accounting treatment of government grants. International Accounting Standard 20 requires grants to be recognized as income over the relevant periods to match them with the related cost which they have been received to compensate. This should be done on a systematic basis. Grants should not therefore be credited directly to equity. Where grants are received in relation to a depreciating asset, the grant will be recognized over the periods in which the asset is depreciated and in the same proportion. So in order to explain the point number 2, we have an example. XYZ company receives a government grant representing 50% of the cost of the depreciating asset, which cost 40,000. How will the grant be recognized if XYZ company depreciate the asset over 4 years straight line or at 40% reducing balance? See, the principle is that the grant will be recognized over the period in which the asset is depreciated and in the same proportion. So see, in first A over 4 years straight line, second at 40% reducing balance. This means 50% is the grant, this means 20,000 is the grant from the government. So this grant will be spread over 4 years in first case. And in A, it is straight line of depreciation. So simply we shall be dividing this 20,000 with 4, this will give us 5,000 per year. So this means this 20,000 will be recognized over 4 years in which the asset is depreciated and in the same proportion. Because asset is being depreciated over 4 years using straight line method. And we discussed in our last session, as you all know, that straight line method of depreciation is simply cost minus residual value divided by the useful life. So here there is no residual value, so we are assuming residual value is 0. So 40,000 is the cost. 40,000 is the cost, and the related government grant is 20,000. So 40,000 will be depreciated over the period of 4 years. So this means every year depreciation will be 8,000. Sorry, it should be 10,000. It should be 10,000. When you divide 40,000 by 4, this will give you 10,000. So this will be the depreciation charge, and this depreciation charge in case of A will be the same for the next 3 years. So likewise, the government grant of 20,000 will be spread over those 4 years. This is one. Second, so if we look at the answer, okay, let me change it to the normal. Okay, so this is the answer. In year 1, this is the depreciation, this is the depreciation, and these are the government grants, and in total this will become 20,000. Mean government grant will be recognized over the period of the life of the asset, and in the proportion and in the manner the asset is being depreciated. In case of B, when asset is being depreciated using reducing balance method, for example. So this government grant will also be recognized using reducing balance method. So here it is 8,000, 4,800, 2,880, 4,332, 4,320. So if anybody has a question related to this example, so I can explain that. The principle is, I just show you the principle again. The principle is that where grants are received in relation to a depreciating asset, the grant will be recognized over the periods in which the asset is depreciated and in the same proportions. So this was the principle and this was the example. Do we have any question related to this?
Qasim Iqbal is saying, so please share the entries as well in relation to the grants.
Okay.
Muhammad Amin is saying we are writing off grants in 4 years. However, the balance amount in each year shall be treated as the liabilities.
Yes. Mr. Amin, yes. And please repeat the first question so that I could. Before Mr. Amin.
Qasim Iqbal is saying, so please share the entries as well in relation to the grants.
Okay. The entries will be, for example, when you receive the grant, you debited cash, say it was received in cash 20,000, and credit deferred income. So this was deferred income 20,000. This was on initial recognition. At the end of year 1, debit this deferred income, credit, say other income, or I'll be using here, say profit and loss account. So in case of A, this entry will be 5,000 and 5,000. So at the end of year 1, 15,000 will be the deferred, closing deferred. Okay, let's move further. Number three is there may be a series of conditions attached to a grant in the nature of a package of financial aid. An entity must take care to identify precisely those conditions which give rise to costs, which in turn determine the periods over which the grant will be earned. When appropriate, the grant may be split and the parts allocated on different bases. An entity may receive a grant as compensation for expenses or losses which it has already incurred. Alternatively, a grant may be given to an entity simply to provide immediate financial support where no future related costs are expected. In cases such as these, the grant received should be recognized as income of the period in which it becomes receivable. And number 5, a non-monetary asset may be transferred by government to an entity. Someone asked question related to this area, and now this is being, though I answered that question, but that principle is being covered here in point number 5. A non-monetary asset may be transferred by government to an entity as a grant. For example, a piece of land or other resources. The fair value of such an asset is usually assessed, and this is used to account for both the asset and the grant. Alternatively, both may be valued at a nominal amount.
Sayyid Shah is saying, she can repeat the third point.
Okay.
It's not clear.
The third point is there may be a series of conditions attached to a particular grant. So an entity must take care to identify precisely those conditions which give rise to cost, which in turn determine the periods over which the grant will be earned. Where appropriate, the grant may be split and the parts allocated on different bases. For example, if in the whole package a part related to your income, your operating activities, and a part related to the assets acquired under that project. So the portion related to the assets will be spread over the life of the asset and will be recognized in the pattern. Those assets will be depreciated, whereas the portion related to the income will be recognized as you fulfill the conditions attached to that portion. I hope this should be clear.
Abdullah Azbari is asking, what if the asset has an indefinite useful life?
If an asset has an indefinite useful life, so then because this will be recognized in the pattern. For example, if you say you have been given a piece of land. Yes, land has an indefinite life, but see, does that agreement contain any additional condition requiring something else, something additional? If it is there, for example, if you are required to build the building on that land, only then you will be entitled to that land by the government. Then that building, the life of the building will be a reference. You will be recognizing that grant over the life of that building. Next.
Muhammad Amin is asking, why are we ignoring time value of money in recognition? Shall we discount the grant for coming years?
No, we are not ignoring. Of course, wherever question will allow us, we will be recognizing that. Okay. So next is number 6. Number 6 is, in case of grants for non-depreciable assets, certain obligation may need to be fulfilled. As I just discussed, point number 6 covers that concept, in which case the grant should be recognized as income over the periods in which the cost of meeting the obligation is incurred. For example, if a piece of land is granted on condition that a building is erected on it, then the grant should be recognized as income over the building's life. So normally, whenever you receive an asset, land is an example of an asset which has indefinite life. So see, is there any other condition? And normally there is another condition, because only providing you the land is not normally the objective of the government grant. So see the additional condition and treat that government grant accordingly. So next is how the grant will be presented. How the grant will be presented in the financial statement which is related to the asset. There are two choices here for how grants related to assets, including non-monetary grants at fair value, should be shown in the statement of financial position. First is, set up the grant as deferred income. Second, deduct the grant in arriving at the carrying amount of the asset. We can understand this presentation with the help of this small example. A company receives a 20% grant towards the cost of a new item of machinery, which cost $100,000. The machinery has an expected life of 4 years and a nil residual value. The expected profits of the company before accounting for the depreciation on the new machine or the grant amounted to $50,000 per annum in each year of the machinery life. So let's see how this will appear in the financial statement. For example, if you have the policy of, if you have this policy, then this will appear like this, because you have reduced the cost of the asset. So profit before depreciation is 50,000 and depreciation will be 20,000. The depreciation charge on a straight line basis for each year is 100,000 minus 20,000, which is government grant. So this will give us 20,000. Statement of financial position will appear like this. This is the non-current liability, non-current asset, sorry. 100,000 minus 100,000 minus government grant. So this is the value of the asset we initially recognized at. Then we reduce this amount with the depreciation. This will give us the carrying amount at the end of the first year. And sorry. And in the second year, 40,000 will be the carrying amount of this asset. This is the accumulated depreciation of 2 years, and this is the cost on initial recognition after deduction of the government grant. And likewise in year 3, the carrying amount is 20,000, and in year 4 this is C. So this is one way of you in the statement of financial position you do not see any government grant account, because right at the start you netted it off against the cost of the asset. But if you set up the grant as deferred income right at the time when you were entitled to receive that grant, so the presentation will be different. Say here you can see that in year 1 this is the cost of the asset, because there is no deduction from this cost, and this is the first year depreciation on the basis of the straight line, 25,000. So this is the carrying amount. And on the liability side, you will see that 15,000 after first year recognition of 5,000, 15,000 will appear as a deferred income. Likewise in year 2, you will see the presentation like this: 100,000 cost minus accumulated depreciation. This will give us the carrying amount, and then 10,000 will be the remaining deferred income. Likewise in year 3, and in year 4. In year 4, because the whole deferred income is recognized over the 4 year, and in profit and loss account you can see that profit, depreciation, and you will see the grant income will appear here in year 1, in year 2, in year 3, in year 4. But if you just compare it with the last slide, you can see that you do not see any grant in this calculation, because that is deducted right at the when you recognize the asset initially, you deducted that grant from the cost of that asset. So this is the presentation of the government grants. So you have a choice. You can present it in either way. Then is presentation of grants related to income. These grants are a credit in profit or loss, but there is a choice in the method of disclosure. Present as a separate credit or under a general heading, for example, other income. Deduct from the related expense. So you have the choice in case of grants related to income. But if you are required to repay the grant, then it should be accounted for as a revision of accounting estimate. It should be accounted for as a revision of accounting estimate. Revision of accounting estimate. Repayment of a grant related to income. applied first against any unamortized deferred income set up in respect of the grant. Any excess should be recognized immediately as an expense. Then repayment of a grant related to an asset. Increase the carrying amount of the asset or reduced the deferred income balance by the amount repaid. The cumulative additional depreciation that would have been recognized to date in the absence of the grant should be immediately recognized as an expense. See, if you have not deducted the cost of the asset by the government grant, this means you have separately recognized the government grants as a deferred income. So what is the treatment? Simply the remaining amount in the deferred income will go. See, let me explain point number B. See, in case of point number B, I hope the treatment in case of income is very clear. It's very straightforward. If there is a deferred income account, any balance remaining within that account will be debited, and if you are required to pay even more than the balance in the deferred income account, so that will be treated in the profit and loss account. The same is the treatment. Like in case of asset, we just learned that there are two methods. One is deduct the government grant from the asset cost. This is one method. And the second is separate recognition of government grant as deferred income. In this case, the treatment will be the same as in case of income. For example, if in deferred income account the balance outstanding is say $1,200, and you are required to pay say $800. You are required to pay $800. So what you will be doing, you simply debiting deferred income account with 800 and credit cash with 800. So I think I should use another slide for this purpose. So do I have any other? Yes, raise all trials. So let me raise all trials. Okay. See, in case of asset, actually I am discussing with you, my camera is in this direction and my screen is in this direction. So when I want to explain anything in the form of the journal entry, so I'll have to see on right hand side in order to explain. So please, this does not mean I'm not with you. I am with you, but I have to explain it by looking towards my right. Okay, let's see in case of asset. In case of asset, deduction mean if you have deducted the government grant from the asset, and separate mean if you have separately recognized this government grant as a deferred income. See, I was discussing that the treatment for A and the treatment for this case will be the same. This means the amount, if you are required to pay any amount, first you will adjust it against the deferred income account. But if the balance lying in the deferred income account is not sufficient, any excess should be recognized immediately as an expense. In order to explain this, for example, I'm just talking about this separate and number A's because both have the same treatment. See, if the balance within deferred income is, say $1,500, and you are required to pay, say, repayment, you are required to pay to the government because you have not fulfilled some of the conditions and you are required to pay. For example, you are required to pay, say, 900. So we can see that the in the deferred income account, balance is sufficient to cover this amount. So the entry will be very simple: debit deferred income with 900 and credit, say, cash or bank, whatever you use, 900. So this is one case, and I am discussing only this situation, separate and A. In case the repayment is deferred income is 1,500, same amount, but repayment is like say 2,200. So now your entry will be debit deferred income. Okay. It's not working. Deferred income debit and credit cash or bank. How much cash will be paid? We will be paying 2,200. But we have paid 2,200, but we only have with us in the deferred income 1,500. So the deferred income will be debited with 1,500, not more than this. So what about the balancing figure? The balancing figure will go to the profit and loss account, and that is 700. So this is the treatment for when you separately recognize the deferred income, or in case of A. In case of B, it is written over here. Simply increase the carrying amount of the asset or reduce the deferred income balanced by the amount repayable. Simply deferred income will increase if you are repaying it, because previously you reduced that asset. Now you will be debiting that asset and crediting the cash. And likewise, the depreciation effect will be, as a result of this repayment, you are unable to depreciate this much portion of the asset. Now you will be immediately recognizing the depreciation related to this portion. Do we have any questions so that we could move? Otherwise, we will move forward. Okay, please.
Hassan Shah is asking, is there any preferred method out of deferred income method and carrying amount method by IAS?
No. You can use either of these two methods.
Abdullah Al-Sabahi is asking, so basically of the land granted for building a station, an electric station or something, the station will also be kept, maintained and upgraded to provide electricity services for a definite period, for an indefinite period. Even we may build a new station on the land to replace it. The land is granted to cover all such costs. What will be the accounting entries to recognize this?
See, this is again judgmental. We'll have to see but you cannot recognize it directly in the equity. We'll have to see the specific situation. What are the other terms and conditions? Sometime apparently it seems, but you may find some other terms and conditions within that agreement. But if we assume that there is no other condition, so this is then you can recognize it immediately. That is allowed. But you cannot transfer it directly to the equity. This is the point. This is the point. International Accounting Standard 20 does not allow you to transfer any government grant directly to the equity. Like for example, if you have already incurred the expenditure and now government have announced something, as a result you will be receiving an amount. So you can recognize that amount immediately because you have already fulfilled those conditions. That's not the issue.
Mohammed Imran and Ahad Amir are asking, what about 600 remaining? And Ahad is saying, in separate case, if we have to repay 900, then why are we keeping the rest of 600?
See, government, because we might not have fulfilled certain conditions. So as a result, government required us to pay 900. So 600 will be treated the way we just discussed, that we will keep on recognizing that 600 over the life of the asset.
Muhammad Amin is asking, balance $700 charged to expense should be treated under which particular head of expense? Shall this be under other expenses or as interest to government?
Mr. Amin, we have just okay, let me close this.
There are a few more questions there.
Okay, fine, but let me answer Mr. Amin because we have just discussed this thing. Okay, let me raise this. I hope you people will not mind it because without raising, I think this will not work. Even then, it is not working.
Sorry, what happened?
Okay, so yes, Mr. Amin, here is the answer of your question. That the grants, so there is a choice in the method of disclosure that present as a separate credit or under a general heading, for example, other income, or deduct from the related expense. Okay, next question.
Yes, the next one is from Hamdullah Hussain, saying, suppose if the recipient failed to comply the condition attached and required to pay a fine, how do we account the fine and the grant?
As an expense, and the same way, whatever amount you are repaying, that will be treated according to this slide.
Salman Mehdi is saying, I am confused between the repayment of $900 and the repayment of $2,200.
So what is your confusion, so that I could explain it?
Muhammad Zanuran Khwaja is saying, amount will be charged to depreciation in same year, whatever we have to pay to the government case in case B.
Yes, you will be recognizing the whole depreciation related to all the previous year within that current year.
Muhammad Imran Iqbal Sethi is saying, I want to know depreciation effect from day one or from day when the repayment of grant is made.
Who is he? Mr.
Muhammad Imran Iqbal Sethi.
Mr. Imran, this is possible, but we have to discuss so many things. So if you have any specific question like how to do this, so then I will be answering that. It is not possible for me to create a whole new illustration, keeping in view the shortage of time.
Asif Majid is saying, sir, can you provide an example of Part B of repayment of government grants?
Part B of repayment of government grant, I just provided you the example. In case of like asset, who is this gentleman?
Asim Majid.
Asim, I hope the example which I provided for when you recognize government grants separately, I hope that is clear. Now, related to deduction. See, if I try to explain it very quickly, like if you have an asset, like its cost is say 100,000. Government and its life is say 4 years. Life is 4 years. Okay, and government grant is say 20,000. Year one, this is year one. Year one, this is the case. Now you will be recognizing your asset initially at 80,000 after reduction of government grant. Okay. So at the end of year 1, the carrying amount, CA, mean carrying amount, please remember, of asset will be 60,000 after first year depreciation. And there is no government grant because we have deducted it while measuring the asset initially. In year 2, carrying amount of the asset will become, say, 40,000. Now, if you are required to pay this grant at the end of year 2, for example, you are required to repay it 10,000. So what will be your entry? Of course, cash will be credited because you are paying cash. What will be the debit? Asset will be the debit. Debit, asset, 10,000. This will be the entry. This is one entry. Second is, because you repaid 10,000 out of 20,000 and no depreciation was charged on this 10,000. Had it been known, or you would have received just 10,000, so you would have depreciated this asset, you would have depreciated 90,000 over a period of 4 years instead of 80,000 over a period of 4 years. So this means 10,000 you will be calculating, okay, over the period of 2 years, how much additional depreciation we have charged. So for 1 year, 2,500, for 2 years, 5,000 would be additional depreciation. So I just place these figures in this statement. So repayment of a government grant related to the asset. So asset cost was 100,000 and we are repaying 10,000. Actual grant received was 20,000. The carrying amount of the asset increase. So carrying amount of the asset will increase by 10,000. The cumulative additional depreciation. What is cumulative additional depreciation? Related to this repayment, which is 10,000. For 2 years, the accumulated depreciation will be 5,000. Would have been recognized to date in the absence of the grant, should be immediately recognized as an expense. So you will be recognizing this amount, mean depreciation expense debit 5,000 and accumulated depreciation credit 5,000. I tried to illustrate it very quickly because I hope this should be clear.
Muhammad Imran is saying, saying thank you very much.
You're welcome.
Muhammad Imran is saying, why we amortize 600 over the life of the asset as we are charging the expense 700 in the year in which repaid, but in case of 600 it is spread over the remaining life.
This question relates to, I think, our previous illustration. Can you please repeat? I try to understand it so that we could answer it.
Why we amortize 600 over the life of the asset?
See, 1,500, I suppose, was balance in our deferred income, and we repaid 900 and 600 was remaining. So previously it was being recognized and we will continue that way. Only what happened, previously the remaining balance was 1,500, now the remaining balance will be 600. See, this 1,500 is not the grant amount. This amount is after recognizing over the years. This is the remaining balance in the government grant, and we paid 900 out of this. So whatever is the remaining amount in this account, this will of course be recognized over the remaining life of that asset. In the pattern, the depreciation is being charged on that asset. Yes, please.
Salman Mehdi is asking, are we repaying $900 and $2,200 separately?
Yes, that is case number 2. See, Mehdi, I assume like we have a 1,500 balance in the government grant. One situation is if we pay 900 what will be the entry? Second situation is balance is 1500, but if we are required to pay 2200, so what will be that? Mehdi, I hope it should be clear.
The last two questions. The first one is Syed Shah. He's saying that the repayment should be done once the company realized that it would not fulfill government obligation, even if government didn't notify at that particular time. I think as per prudent concept, it's like this. Please confirm.
Yes, you're right.
Jody Lal is asking if repayment are made in later years with the amount which is more than 50% of the grant income, which has already been recognized. Do we need to consider it retrospectively?
No.
Since more than the income we've already recognized.
See, this is a revision of an accounting estimate. This payment is a revision of accounting estimate. Accounting estimate is always treated prospectively. Okay.
That's right. Thank you.
Okay. Now the last slide is okay. Then we will move to another standard. The last slide is. Government assistance. Some forms of government assistance are excluded from the definition of government grants. Some forms of government assistance cannot reasonably, we are repeating in fact this. So I suppose we have discussed this concept earlier. So I can move further. Very simple disclosures, disclose the accounting policies, nature and extent of government grants, unfulfilled condition and other contingencies attached to the grant. And then is the interpretation 10. We have learned the principle that the principle within this interpretation is you cannot, whatever is the case, you cannot directly recognize the government grant in the equity. You will have to route it through the profit and loss account. So this was the principle established in this interpretation. Okay. So don't take it as an end of session. Though saying thank you is a good thing, but we need to move to another standard, and that is International Accounting Standard 23. International Accounting Standard 23. Okay, let me open it here as well. International Accounting Standard 23, borrowing cost. First of all, scope. The standard does not deal with that. This is very important standard, borrowing cost, because there is no allowed alternative. So you will have to capitalize the borrowing cost related to the qualifying asset, with few exceptions. So this is very important. The standard does not deal with the actual or imputed cost of equity, including preferred capital not classified as a liability. Second is, an entity is not required to apply the standard to borrowing cost directly attributable to the acquisition, construction, or production of qualifying asset measured at fair value. For example, biological assets. You are not required, or inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. For example, maturing whiskey. See, after distillation and pre-maturation, dilution, the spirit is put in oak cask to mature. The maturation period can take a variable length of time. All Scotch whiskey must be aged at least 3 years. Anywhere, it could be anywhere between 8 to 30 years in common. And the longer the spirit has aged, the smoother the taste, and but also the more costly the end product will be for the consumer to buy. So far as the taste is concerned, I am copying it from somewhere, but myself is not sure about this taste. So this was the second point. Third was, okay, so these are important. This scope is important. We need to remember if we are using any equity element. In fact, first is related to the equity element. Any cost related to, if you are issuing equity in any form, even preference share, if they are not liability, so that will not be covered under ISA 23. This is one thing. And second is, in these two types of asset, standard does not require you to capitalize borrowing cost. So these two important points. Next, what is the definition of borrowing cost? See, borrowing costs include interest and other costs that an entity incurs in connection with the borrowing of funds. Borrowing costs include interest on bank overdrafts and borrowings, amortization of discounts or premiums on borrowings, finance charges on finance leases, and exchange differences on foreign currency borrowings, where they are regarded as an adjustment to interest costs. Then there is a definition of qualifying asset. A qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Examples could be manufacturing plants, power generation facilities, and investment property during the construction period. Intangible assets during the development period, bearer plants, or made-to-order inventories. Financial assets and inventories are manufactured or otherwise produced over a short period of time. Please remember two more matters. One is financial assets and inventories that are manufactured or otherwise produced over a short period of time are not qualifying asset. And assets that are ready for their intended use or sale when acquired are not qualifying asset. These are the definition. And what is the basic principle? The basic principle is borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset form part of the cost of that asset. Other borrowing costs are recognized as an expense. So let's explore this principle. So I have listed measurement rules. So I will try to explain them with the help of illustrations wherever possible. The first rule is, where funds are borrowed, specifically borrowing cost, for example, interest and amortization of issue cost. Issue cost is also a part of the borrowing cost, issue cost of the loan. Eligible for capitalization are the actual cost incurred less any income earned on the temporary investment of such borrowings. So when you have borrowed funds specifically for the construction of a qualifying asset, the actual interest, including if there is any issue cost related to that loan, so that will be actual cost related to a loan, and its issue cost will be capitalized as part of the cost of the asset. But if you have temporarily invested those funds while the remaining amount is being utilized for the construction of that asset, that income from that temporary investment will reduce the borrowing cost before capitalizing that amount in the cost of that asset. This is a small illustration in front of you. See, on 1st January 2014, ABC Company borrowed 3 million to finance the production of two assets, both of which were expected to take a year to build. Work started during 2014. The loan facility was drawn on and incurred on 1st January 2014 and was utilized as follows. The remaining funds invested temporarily. So this means in fact, we borrowed 1 million for asset A. You can treat it, this was borrowed specifically for asset A, and 2 million for asset B. The loan rate was 9% and the ABC can invest the surplus funds at 7%. We borrowed 1 million. So if we just discuss asset A, so 500,000 was utilized immediately on the receipt of the loan of 1 million. And the remaining 500,000 was required after 6 months. So for 6 months, 500,000 was invested and company earned income at the rate of 7% per annum. So let's calculate the borrowing cost, and for asset B this will be your pop-up question, but I'm informing you beforehand so that be careful in understanding the calculation for asset A, because the same will be applicable to asset B. See, you have borrowed for asset A. Here we are calculating for asset A. What was your interest cost? Your interest cost was 1 million into 9%. So this will give you 90,000. This will give you 90,000. But we know that out of this 1 million, 500,000 was invested for a period of 6 months. So we earned income equal to, like we invested 500,000 at the rate of 7% for 6 months. So this will give us 17,500. So this way, borrowing cost to be capitalized in asset A, in the cost of asset A is 72,500. So this is the borrowing cost to be capitalized. Mr. Harun, can you help me in writing the small question? Like calculate.
Yes.
So, capitalized. Calculate borrowing cost to be capitalized in case of asset A, sorry, in case of asset B, because we have calculated for asset A. In case of asset B, option 1 is 180,000. Option A is 180,000. Option B is 270,000, 27, and option C is 145,000. So we can give them 1 minute. Slides are in front of them. See, we have borrowed for asset B 2 million. This is a specific loan. Okay. Yes.
Have they all seen the question?
This is available with them. This slide is available with them.
Alright, there you go. So, ladies and gentlemen, the poll question is in front of you. About 20% people have already voted.
सारी चीजें एक साथ यही हो सकता है इसमें.
About 30% have voted. I'm giving you 10 extra seconds. Don't be afraid of a wrong answer. It's not going to cost you any points, any brownie points. So just give an answer so that you at least know whether your answer was right or not. I think that's it. We've reached the time. Closing it. Sharing the results with all of you. The results say that 26% think it is 180,000.
Okay.
31% think it is 270,000.
Okay.
And 43% thought it was 140,000.
Though I cannot say this is the majority, but anyway, 145,000 was the correct answer and 43% people answered it correctly. So simply, see, this was the 2 million. Okay, if I come back over here, what was the actual cost on this loan? Very simple. Rate is 9%, the actual cost 9% is 180,000. So what you invested, see, 1 million was incurred right at the start, but the remaining 1 million was invested for 6 months. So there was an investment income on 1 million at the rate of 7% for 6 months. So this was the investment income, 35,000. So this will give you, the correct answer is 145,000. So if we just go back to our previous slide, we can see that where the borrowed funds are borrowed specifically, then actual cost. What is the actual cost for 2 million? Actual cost was 180,000, and about 20% people did not reduce that 180,000 with this temporary investment of 1 million. Okay, let's move further. Point number 2 is where funds are a part of a general pool. The eligible amount is determined by applying a capitalization rate to the expenditure on that asset. The capitalization rate will be the weighted average of the borrowing cost applicable to the general pool. However, borrowing cost calculated in this way must not exceed actual borrowing cost incurred. So let's see another example. Here we will learn how to calculate the capitalization rate. Here is a formula. Capitalization rate is equal to borrowing cost incurred divided by borrowing outstanding. Very simple formula. See, in this case, bank loan 18% 4 million, bank loan 20% 5 million, bank loan 22% 3 million, so total 12 million. The company year end is 31st December 2014. The bank loan of 20%. This bank loan of 20% was taken on April 30th, 2014. Other loans were brought forward from 2013. So, what will be the capitalization rate? See, the capitalization rate is what was our borrowing cost? What was our borrowing cost? So, this is simply the actual amount of interest which we have paid on this pool. So, this loan was outstanding for the whole year. So, we have paid 18% into this amount as an interest, and this was outstanding for the whole year. So what is the value of so the amount of the interest we paid at the rate of 18% comes to 720,000 plus this loan was outstanding. This was taken on April 30, 2014. This means during 2014, this was outstanding for like May, June, 8 months. So this 5 million was outstanding for 8 months. So we will apply 20% on this 5 million, and then we will multiply with the fraction in order to calculate the borrowing cost related to this loan. Then 3 million was also outstanding for the whole year. So the amount will become 660,000. So this is the borrowing cost. Simply actual interest which you have paid on that pool. On this you have paid 720,000. This you have paid this much because this was outstanding only for a part of the year. So you have paid a lower amount instead of for the whole year. So this was also outstanding for the whole year, so you have paid interest for the whole year. So when you add up all these figures, so this will give you the borrowing cost incurred. Then is the borrowing outstanding. See, borrowing outstanding, this 4 million was outstanding for the whole year. So what you will be doing, you will be multiplying it with factor 1. So no need to multiply it with factor 1. So that will not change this figure. 5 million was outstanding for only 8 months. So you will multiply 5 million with this factor, plus 3 million was also outstanding for the whole year. So the factor is 1. So we need not to multiply this with 1. So this will give you 19.81%. So this way you can calculate your capitalization rate. Do we have any questions so that we can take those questions?
There are 3 questions so far.
Yes, please.
More will come in. One is from Mohammed Fahad Islam. He's saying, what if, and I think this relates to the previous discussion, what if only 5% of the loan required is used for acquisition of the asset? Whether finance cost is capitalized in this case or not?
Sorry, 5% of?
The loan acquired is used for the acquisition of the asset.
Okay.
Whether finance cost is capitalized or not in this case.
Finance cost related to the 5% portion will only be capitalized.
Muhammad Mansoor Khan is saying, what is qualifying time period? As it will vary from asset to asset. Does the standard mention any specific time period?
Mr. Mansoor, we shall be discussing this point in the coming slides. But even if it is not answered, please, you are welcome to ask it again.
Salman Mehdi has asked, with regards to the first illustration, do you add 145,000 to the cost of the asset?
Yes, this is the borrowing cost. So in order to calculate the cost of the asset at the end of that year, this 145,000 will be added to the 2 million.
Sayyid Shah has asked, can we use the company's weighted average cost of capital if it's a complex situation, that is to determine the borrowing cost?
That's what we are discussing. If you are using funds from a pool, so the weighted average cost of that pool can be used for the calculation of borrowing cost.
Okay, Zain Ahmed is saying, asking for Namaz break. There are 3 more questions.
After 5 minutes, we will be having namaz break.
Salman Mehdi is saying, but part of $4 million and $3 million has already been paid in 2013 as the first installment. So why do we include it in borrowing?
No, nothing is paid. Nothing is paid.
Okay. Nothing is paid. Maybe you need to, Salman, you need to have a look at the question again. Qasim Iqbal is saying, sir, please explain what if some of the amount of loan is temporarily invested from the general pool?
Yes, if you take something from the general pool, that for the calculation of the borrowing cost related to that portion, you will be using the weighted average rate for that particular pool. But if you have, in addition to that, if you have borrowed specifically for that, for the construction of that asset, then that actual rate will also be used.
Okay, the last question is from Nasser Ali saying, why are we calculating the capitalization rate? What are its merits?
See, if we just go back to our last slide. Here we learned the measurement principle given in the standard. Where funds are part of a general pool, the eligible amount is determined by applying a capitalization rate to the expenditure on that asset. Any other question?
That's it.
Okay. So we can have a break of prayer, and we will be back after 10 minutes.
Yes.
Thank you very much. Welcome back. I hope you people have said your prayer. So we learned the calculation of capitalization rate with the help of this example. Now this is illustration number 2. So here we shall be applying the measurement principle we learned in B. XYZ company had the following loans in place at the beginning and end of 2015. 1st January 2015, 31st December 2015. 240,000 was outstanding throughout the year, and 9.5% bank loan repayable 2019. This was outstanding throughout the year, and this was the new loan. Sorry. This was the new loan. 8.9% eventually repayable 2017. So they obtained this loan during the year. The 8.9% was issued to fund the construction of a qualifying asset, a piece of mining equipment, construction of which began on 1st July 2015. On 1st January 2015, XYZ company began construction of a qualifying asset, a piece of machinery for a hydroelectric plant using existing borrowings. Expenditure drawn down for the construction was 30 million on 1st January 2015, 20 million on 1st October 2015. Calculate the borrowing cost that can be capitalized for the hydroelectric plant. See here, there are 2 types of plant. One is a piece of mining equipment. Requirement is not related to the piece of mining equipment, and this 8.9% loan was related to this, specifically for this piece of mining equipment. So requirement is not about this loan and about piece of mining equipment, so we are not considering this loan. on 1st January, XYZ company began construction of a qualifying asset, a piece of machinery for a hydroelectric plant. So this is question, the requirement relates to hydroelectric plant. Okay, fine. Using existing borrowings, these are the existing borrowings. These two are the existing borrowings. This is specific loan for mining piece of mining. This is specific loan. This is existing borrowings. Hydroelectric plant was financed through the use through the funds from this existing borrowing. Okay. First of all, we will calculate the capitalization rate. See, capitalization rate is very simple. We just learned actual interest on 240,000. What will be the actual interest on this loan? The actual interest will be on this loan will be 2.94. Okay, sorry. This is 240,000 into 10%, and this was outstanding for the whole year. So this will give us 24 plus 160,000, 9.5%, and this was also outstanding for the whole year. So this will give us 160 into 9.5%. So this will give us 15.2. So here the borrowing outstanding, and both were outstanding for the whole year. So the factor multiplied to these loans was 1. So this will give us 39 in the numerator, and in the denominator this will give us 300, 400. I suppose the total of the denominator is 400. So this will give us 9.8%. So this is our capitalization rate. So in order to calculate the borrowing cost, so we will see the utilization of the funds. 30 million was taken right at the start of the year. So this means 30 million out of these funds for the whole year. So 9.8% will be multiplied to this. And 20 million was issued on 1st October. So this means October, November, December. So for 20 million, 9.8%, and 3 by 12. So this will give us 2.94 and 0.49. So this is the borrowing cost which will be capitalized. So if we just relook at this illustration, see, read the illustration very carefully. This loan was the specific loan for another qualifying asset. So this does not relate to our requirement. Our requirement was related to hydroelectric plant, and this plant was financed through the use of these two types of loan. So what we did, first of all, we calculated its capitalization rate. In the numerator we have actual borrowing cost, and in the denominator we have the loans, principal amount of the loan outstanding during the year. So this will give us the capitalization rate, and then we see how much we have taken from these existing loans. On 1st January we took 30 million, so this 30 million interest will be calculated for the whole year, and this 20 million was taken on 1st October, and this was outstanding for 3 months. So we have calculated interest cost on this for 3 months. So this will give us the borrowing cost, which will be capitalized to the hydroelectric plant. Okay. So if we have, okay, let's discuss a few more slides. By the time, if you people have any question, we can answer that. Principle C is capitalization should commence when expenditure are being incurred. Borrowing costs are being incurred and activities that are necessary to prepare the assets for its intended use or sale are in progress. This may include some activities prior to commencement of physical construction. However, an entity does not normally suspend capitalizing borrowing cost during a period when it carries out the substantial technical and administrative work. An entity also does not suspend capitalizing borrowing cost when a temporary delay is a necessary part of the process of getting the asset ready for its intended use or sale. For example, capitalization continues during the extended period that high water levels delay construction of a bridge if such high water levels are common during the construction period in the geographical region involved. D is capitalization should be suspended during periods in which active development is interrupted. I have just explained that if it is a necessary part of that development process, then this capitalization will not be suspended. Capitalization should cease when substantially all the activities necessary to prepare the asset for its intended use or sale are complete. And further, if only minor modifications are outstanding, this indicates that substantially all of the activities are complete. G is where construction is completed in stages, which can be used while construction of the other parts continues. Capitalization of attributable borrowing costs should cease when substantially all of the activities necessary to prepare that part for its intended use or sale are complete. For example, a business park comprising several buildings, each of which can be used individually, is an example of the qualifying asset for which each part is capable of being usable while construction continues on other parts. So the loan related to the part completed will be capitalized in that part, and we will not continue capitalizing the borrowing cost on that completed part. Another example is of qualifying asset that needs to be completed before any part can be used is an industrial plant involving several processes which are carried out in sequence at different parts of the plant within the same site, such as a steel mill. Then is an illustration, small illustration. Apex issued a 10 million unsecured loan with a coupon nominal interest rate of 6% on 1st April 2009. The loan is redeemable at a premium, which means the loan has an effective finance cost of 7.5% per annum. The loan was specifically issued to finance the building of a new store. So this was a specific loan, and this was issued to build a new store, which meets the definition of a qualifying asset in IAS 23. Construction of the store commenced on 1st May 2009, and it was completed and ready for use on 28th Feb 2008, but did not open for trading until 1st April 2010. During the year, trading at Apex other stores was below expectations. So Apex suspended the construction of the new store for a 2-month period during July and August. The proceeds of the loan were temporarily invested for the month of April 2009 and earned interest of 40,000. Calculate the net borrowing cost that should be capitalized as part of the cost of the new store and finance cost that should be reported in the income statement, means the amount of the borrowing cost. See, if we calculate, we took this loan on 1st April, our year end is 31st March. So total interest cost is 10 million into 6%. 10 million into 6%. So this will give us 600,000. This was the total interest cost, I suppose. 6% was the rate. There is an effective rate given over here, I suppose. Was there? Because this will be calculated on that rate. This is the effective rate. So 7 point, yes. I suppose perhaps effective interest rate was not given, so I assume that this nominal rate was the effective rate. So this will give us 750,000. This will give us, I can improve its presentation by, okay, then. So what happened to this?
It's different.
Okay. Okay, we can resume from here, from current slide. Okay, we have 10 from here. See, this was the effective interest rate. So our total cost was 10 million into 7.5%. This will give us 750,000. Now the question is, how much out of 750,000 is borrowing cost, which will be capitalized in the cost of new store, and the balance will be expensed out. From here we can see that from where it started on 1st April. The loan is repayable at a premium, which means loan effective rate per annum. The loan was specifically issued to finance this, meets the definition. Construction started on 1st May. So from 1st May 2009, and it was completed on 28 Feb 2010. So this will give us May, April, May, June, 8 into 10 months. Minus, there are suspensions. During the year, trading and other Apex suspended the construction of the new store for a 2-month period during July and August. So we suspended its construction for 2 months. So this will give us 8 months. So we utilize these funds for 8 months. See, in this case, 10-month period, however, interest cannot be capitalized during a period when development activity is suspended. In this case, the 2 months of July and August 2009, thus only 8 months of the year's finance cost can be capitalized. So this will give us 8 into 8 by 12. So this will give us 500,000. 500,000 will be capitalized in the cost of the new store, and the remaining 250,000 will be expensed out. And what about this 40,000? See, this 40,000 was earned during the period when the borrowing cost was not being capitalized. So this will not reduce the borrowing cost, because the principle is interest was earned during a period in which the finance costs were not being capitalized. Thus, the interest received of 40,000 would be credited to the income statement and not to the capitalized finance cost. So this 40,000 will go to the profit and loss account. Had it been earned during the period when the borrowing cost was being capitalized, this would have reduced this 500,000. So if anybody has any question, Mr. Amin is still there. Mr. Amin, if you are listening to me, related to the International Accounting Standard 20, if you have any specific question regarding the discounting of the government grant, please send that specific situation, or send me your email address. After exploring this issue, I'll be answering you in detail.
There are quite a few questions now.
Okay,
so
fine.
Since about 15 minutes. Salman Mehdi is asking, sir, could you please clarify when do we apply the capitalization rate and when do we capitalize borrowing costs according to illustration number 1?
According to illustration number 1, our illustration number 1 is this. Our illustration number 1, we'll have to go back. This is our illustration number 1. So we shall apply capitalization rate where we finance our qualifying asset from a pool of funds. Here we are assuming that any project which will be financed, that money will be taken from a pool which constitute these 3 loans. Next.
Salman again has another question saying, please correct me. The capitalization rate of 19.8% will be applied to the total loan amount to calculate the borrowing cost to be capitalized. Is that correct?
Sorry, again?
The capitalization rate of 19.8%
okay,
will be applied to the total loan amount to calculate the borrowing cost to be capitalized.
To calculate, no, that this 19.8% will be applied to the amount taken for the construction of the qualifying asset. So this will be applied to these 2 figures.
Rashid Mahmood is asking, we borrow money from bank at 7%, suppose 100 million managed through group active account for installing a new plant. Payment on our behalf is made to the vendor through same account. They send us an invoice for the payment on our behalf and interest. Can we capitalize that interest in our book?
If you are utilizing that loan for the purpose of qualifying asset, then you can.
Reena Mary is asking, my question is that the fund drawn for the construction is $50 and the denominator of the capitalization rate is only $40.
So she is talking about illustration. Reena, you are talking about illustration number 2. Can you please clarify your question?
Alright. Reena, can you clarify your question? In the meanwhile, we'll move on to the next. Sunny Kumar is asking, is IAS 23 borrowing costs still valid or no longer used under the IFRS?
It's still valid.
Okay, Muhammad Hassan Rajani is asking what we are importing the machinery and for that we have to obtain the loan under NDFF scheme. Will the interest and cost of the process be the part of capitalization?
See, you are importing machinery. So we have just learned the rule related to this. See, the rule is assets that are ready for their intended use or sale. If you are importing machinery, so machinery means that is ready for its intended use or sale, then this is not a qualifying asset. So if it is not a qualifying asset, ISA 23 will not be applicable to this transaction.
Reena came back and she said yes, 50 million.
The
illustration.
Okay. let's move to the illustration number 2. This illustration. Rina, I try to redo it very quickly. See, first we need capitalization rate, and these are the two laws from where we calculated the capitalization rate. How we calculated was simply multiplied by 240 with the 10%. This gives us 24, and 9.5% with 160 million. This will give us 160. This will give us 15.2, and in the denominator we will add simply these two loans because both were outstanding during the year. So this will give us 9.8%. So this is our capitalization rate. Now we used 30 million for 12 months and we used 20 million for 3 months during 2015 out of this pool, and 9.8% is the capitalization rate for this pool. So now if we want to calculate what will be the borrowing cost, so we shall multiply 30 million into 9.8%, and because this was outstanding for whole year, so no factor will appear here. So then 20 million into 9.8% into 3 by 12. So if you calculate both and add up, this will give you the borrowing cost that can be capitalized. Rina, I hope it should be clear, but anyway you can see the recording there. I explained it, this calculation, so that may be helpful to you.
Kashif Rashid is asking, kindly give an example of suspended capitalization, point D under measurement.
Yes, we have just seen this illustration. In this illustration, see, they have suspended building of the new store for 2 months because they suppose that they should delay it for some commercial reason. So this was not a part of the development. So this was the suspension.
The Fahad Iqbal is saying, if there is a refinancing of loan during the construction phase of the qualifying asset, so what should be the accounting treatment and how the capitalization rate be affected by this?
Refinancing of what?
Of the loan during the construction period.
During the construction period, if there is a refinancing means you are required to repay that loan and then you refinanced it. This means, of course, when you refinanced it, whatever the new rates are, that will be the borrowing cost. And before that point, you will be applying the original effective interest rate. And after refinancing, whatever is the effective interest rate, you will be applying that rate subsequently.
Najmullah is asking, sir, please explain the situation in which borrowing costs should not be capitalized.
Borrowing costs should not be capitalized when active development has not started. This is one example. This is one. Second is when your qualifying asset is ready for its intended use. So thereafter you will not be capitalizing the borrowing cost. Next.
Rana Hafiz is asking, do we depreciate assets during capitalization of assets under IAS 23?
See, when you are constructing something, so you do not depreciate that. This is a general principle. It is not limited.
Muhammad Amin is saying, thank you very much, the point is clear.
You will.
Tausif Ahmed is saying, can we get the webinar recorded video? Yes, of course, after the session. Rashid Hanif is saying, please explain why interest income of 40,000 is not deducted from the capitalization cost.
Because this was earned during the period when borrowing cost was not capitalized. So that's why this was not deducted from the borrowing cost. Had it been earned during the period when, because this was earned during April, and development started on 1st May. So this means you earned 40,000 during this 1 month when borrowing cost was any cost cannot be capitalized. So any income will also be charged to the profit, will be credited to the profit and loss account.
Tosi Ahmed is asking, can we use 19.8 capitalization rate used to expense out not drawn for the project?
To expense out?
I think the question, the wording is not clear.
Please clarify your question.
Please clarify this. Tosi, can we say that qualifying assets are those which take substantial time to complete?
Yes.
Okay. Mohammed Fahim Islam is saying, if we purchase an asset through a loan, and subsequently government agreed to pay the 30% loan, then what will be the treatment for government grant and capitalization government grant?
This is the government grant, and you have two options: either to reduce the value of your asset, or you can record that government grant separately.
Three more questions. Mohammed Zanurin is saying, during suspension period, illustration number 3, you have not capitalized borrowing costs. But at the same time, you are saying if we capitalize this period borrowing cost, then we can deduct income from deposit. So my question is, can we capitalize suspension period borrowing cost or not?
No, we cannot capitalize. Mr. Khwaja, see, when our active development is suspended, any cost related to the suspended period will not be capitalized, and any income earned during this period will not reduce the borrowing cost. Both will go to the profit and loss account.
Last question is from Muhammad Imran. Muhammad Imran is saying thank you, he's correct.
Welcome, Zimran.
And 3 more questions.
Okay.
How can we charge the borrowing cost to large pool of assets on the basis of asset cost or some other basis? And repeat, how can we charge the borrowing cost to large pool of assets on the basis of asset cost or some other basis?
See, I think this illustration will help us in answering this question. See, this is the law. This was applied to two assets. What we did was simply how much is utilized or how much is required for asset A and how much is required for asset B. If there is a pool of asset, see how much is required for each asset within that pool. Next.
Okay, 3 questions, and we will
continue because
it's time.
After 3 questions.
So Asif Ahmed is saying general pool use that should not be used for preparation of asset. What should we do to their borrowing cost?
Again, please.
General pool funds that should not be used for preparation of asset. What should we do with their borrowing cost?
For preparation of asset?
General pool funds that should not be used.
Please clarify your question.
Muhammad Abrar is saying if a company import machinery which would be in working condition in 3 months after on-site installation, will it be treated as qualifying asset?
No, this will not be treated as a qualifying asset.
Okay.
Because this does not require substantial period to be ready for use.
Rina is asking, can we capitalize the borrowing cost on a ready-made asset? For example, the purchase of a vessel or a ship.
I just answered no. See, the principle is assets that are ready for their intended use or sale when acquired are not qualifying asset, even if they require small change, but that period is not substantial, then that will not be a qualifying asset. IAS 23 will not be applicable to them. So I think we should move forward. Okay. So the next standard is International Accounting Standard 40. International Accounting Standard 40. Investment property. Investment property. So let me open it here as well. Investment property. Okay. International Accounting Standard 40, investment property. Let's see the definitions. Investment property is property, land or a building, or part of a building or both, held by the owner or by the lessee as a right of use asset to earn rentals, or for capital appreciation or both, rather than for use in the production or supply of goods or services, or for administrative purposes, or sale in the ordinary course of business. So this is the definition of the investment property. So this is very important in order to study International Accounting Standard 40. What is owner-occupied property? Is property held by the owner or by the lessee as a right of use for use in the production or supply of goods or services, or for administrative purposes. You can see that investment property, if you are using that property for these two purposes, that cannot be termed as investment property. That will be termed as, if you are using that property for purposes mentioned in A, that will be termed as owner-occupied property. Okay. See, an investment property generates cash flows largely independent of the other assets held by the entity, because investment property is held to earn rentals or for capital appreciation purposes. So this means the investment property generates cash flows largely independent of the other assets held by the entity. This distinguishes investment property from owner-occupied property, the production or supply of which is used for the production or supply of goods, and this means owner-occupied property will generate cash flows that are attributable not only to the property but also to other assets used in the production or supply process. International Accounting Standard 16 applies to owner-occupied property, and IFRS 16 applies to owner-occupied property held by a lessee as a right of use asset. So these were the basic definitions. Examples are land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. So this is one example of the investment property. But remember, if an entity has not determined that it will use the land as owner-occupied property or for short-term sale in the ordinary course of business, the land is regarded as held for capital appreciation. So this will be treated as investment property. If a building is vacant but is held to be leased out under one or more operating leases, property that is being constructed or developed for future use as investment property. So that will be treated as an investment property. Then there are specific examples of property which are not investment property. See, the first one is property intended for sale in the ordinary course of business or in the process of construction or development for such sales. So this is not investment property. Second, property held for future use. Property held for future use as owner-occupied property. Owner-occupied property awaiting disposal. This is very important point. If you are going to dispose of an owner-occupied property, so this will not become investment property. Property occupied by employees, whether or not the employees pay rent at market rates, is also not an investment property. Property held for future development and subsequent use as owner-occupied property. owner-occupied property awaiting disposal. This is, I think, the repetition of the earlier point. Property that is leased to another entity under a finance lease. So that is also not a investment property, because when you lease a property under a finance lease, this means in substance you have sold that property, and that property does no longer belong to you. So the question does not arise about the classification of the property. Further, property intended for sale in the ordinary course of business will be treated in accordance with IAS 2 inventories. Property being constructed or developed on behalf of third parties, that will be treated under IFRS 15, and or if an entity wants to apply International Accounting Standard 11, construction contracts. And then the owner-occupied property, as I earlier mentioned, that will be accounted for under International Accounting Standard 16. Then there are other cases. See, if a property, if a portion of that property is being used for rental or capital appreciation purpose, and a portion of that property is being used as an owner-occupied property. So what will be the treatment? Please remember the rule: if these portions could be sold separately or leased out separately under a finance lease, an entity accounts for the portions separately. What is the principle? Like if you have a building and you have rented out a portion within that building, and the rest of the building is being used as an owner-occupied for your offices, for administrative, and for the provision of services, and for the supply of the goods or whatever. So what will be the treatment? If these portions could be sold separately or leased out separately under a finance lease, an entity accounts for the portions separately. If the portions could not be sold separately, the property is investment property if an insignificant portion is being held for use in the production or supply of goods or services or for administrative purposes. If a significant portion is being used as an owner-occupied, then that property as a whole will not be classified as investment property. Instead, this will be classified as an owner-occupied property. An example is when the owner of an office building provides, the second point is if an entity provides ancillary services to the occupants of a property it holds, treat it as investment property if the services are insignificant to the arrangement as a whole. For example, when the owner of an office building provides security and maintenance services to the lessee who occupy the building, so you will be treating this building as an investment property because the services are insignificant to the arrangement as a whole. In other cases, the services provided are significant. For example, if an entity owns and manages a hotel, services provided to guests are significant to the arrangement as a whole. Therefore, an owner-managed hotel is owner-occupied property rather than an investment property. Okay? And the last one is if an entity owns property that is leased to its parent or another subsidiary, it is not investment property so far as the group financial statements are concerned, but it will be treated as investment property in the individual financial statement of the entity. Recognition. Do we have any questions so far?
Yes, 4 questions only. Very quickly asked.
Okay.
And the fifth question now. Tosifem is saying sale in the ordinary course of business means like real estate business?
Yes.
Hamdullah Hussain has asked, should we recognize an investment property where we, the developer of a building on a third party land in return of fixed rent?
So what are the
developer use the building to earn rental income?
See, they are, if they are developer, they are building on the land for the third party. So you will apply construction contracts either under IAS 11 or IFRS 15.
Okay. He was asking whether how will we reflect these in the books of accounts of the developer and the landlord?
Who has contracted with you to for the construction of that building? Okay. For developer who is developing a building or who is constructing a building for third party, as I mentioned, ISA 11 or IFRS 15. And the party for whom you are constructing a building, that party will see what is the purpose of that building. If that will be utilized as an investment property, so that other party will treat it as an investment property. But if that property will be utilized for administrative or other purposes, so then that property will be treated as under IAS 16. But if that property is being developed for subsequent sale in the ordinary course of business, then that property will be treated under IAS 2. I hope it should be clear.
Muhammad Amin has asked, the properties held by real estates for rental shall be treated under IAS 2 as inventory or as under IAS 40 as investment property?
Mr. Amin, I answered it in very detail. If real estate is holding building for rental purpose or capital appreciation, that is investment property.
So Mehdi is saying, can you give an example of ancillary service?
As I just mentioned, like if you provide security and maintenance services. So these are normally insignificant services.
Hamdullah Hussain has further asked, would the treatment be any different if the landlord gets one floor and a fixed rent? One floor in that building and a fixed rent.
For whom? For the developer? For the developer?
It doesn't say that.
Okay.
The landlord gets one floor, and which means the landlord probably keeps the floor.
Keeps the floor for himself?
Yeah.
So this is owner occupied. This will, for that floor will become owner occupied for the landlord.
Tosif Ahmed is saying other cases, other cases like lessee means we have given property on operating lease.
Sorry, can you repeat your question? It's related to point number 2 or 3 other cases. There are 3 points, so please mention which point.
Tosif is saying, can you explain that can finance lease come under IAS 40?
Finance lease does not fall under IAS 40. But anyhow, what is the linkage between IAS 40 and the standard on leases will be discussed in the coming slides.
Reena has asked a similar question saying, under finance lease agreement, is IAS 40 applicable as a guidance for lessee?
Reena, I hope when we will discuss the coming slides, so this question will be answered. Anyway, you are welcome if still not answered.
Rashid Hanif is saying, if maintenance services are substantial, then?
Of course, then you will not treat it as an investment property. As I gave you the example of a hotel. In hotel, services provided to guests are significant. to the arrangement as a whole. Though you are renting that room, but in fact, rest of the services are significant. So that's why owner managed hotel is treated as owner occupied property rather than investment property.
So Asif is saying the third point.
Third point is, so see, okay, the third point is if an entity owns property that is leased to its parent, of course, on operating lease, rental purpose. This means rental purpose, operating lease. So see, if I hope it should be clear, this is operating lease. I mean, I did not use the word operating because for lesser this can be used, because in this case, but entity is lesser, so this is operating lease. So this can be used for lesser. As we learned in our earlier CPD sessions that for lesser standard retained the operating and finance lease terminologies.
Maria Iqbal is saying, please explain property in portions, other cases part 1.
Okay.
First one.
Maria, if an entity has a building, so if the portions within that building could be sold separately, an entity accounts for the portions separately. Like if you might have seen, Pakistan International Airline has a building near Punjab Assembly Hall. They have rented few floors to the third parties, and the remaining building is being used by the Pakistan International Airline. Now the question arises, will this building be treated as an investment property or will this building be treated as owner-occupied property? The answer is, see, can you sell those portions separately? As you know that in this era, you can sell floor by floor. So if it is possible, whatever portion related to portion of the building that is rented, if that portion can be sold separately or leased out separately under a finance lease, then accounts for that portion as an investment property and the remaining portion as an owner-occupied property. I hope it should be clear.
Mohammed Imran is saying, if parent leaves the property at rent to subsidiary, then
we discussed this in point number 3. If they listen to the recording, hopefully he will find it.
Musa Al-Rayami is saying, if other cases, portion of building for rent and operation for administration purpose, owner occupied, then the portion will be for accounting under ISA 16.
Yes, 16.
And ISA 40.
No, portion
Portion of the building
given on rent, that will be treated under 40, and owner occupied under 16.
Mohammed Imran is saying, what would be the treatment? I think to explain that. Nasser Ali is saying, in case of investment properties, are we only accounting for positive appreciation or negative too?
In case of
investment properties,
okay,
are we only accounting for positive appreciation or negative too?
both. We will be having break for Maghrib prayer. If we have finished with the question.
Yes, this was last.
Okay, now we are going to have break for Maghrib prayer, and after Maghrib prayer, we will resume our session. Okay, welcome back.
Unmuted.
Unmuted what?
Was unmuted after camera off here.
Okay.
No Punjabi, please. Nobody's Russian, not in a secret.
Okay. So, Rashid,
Next time I'll have to check whether you muted the system or not.
Okay. So I think I muted the camera, so they don't know who talked and about what.
Alright.
They can guess from the voice. Anyway, recognition. Investment property should be recognized as an asset when two conditions are met, and we know that these conditions are the same for any asset. It is probable that the future economic benefits that are associated with the investment property will flow to the entity. The cost of the investment property can be measured reliably. These are the two conditions. Now come to the initial measurement. The cost of purchase of an investment property comprises its purchase price and the directly attributable expenditure. Directly attributable expenditure includes, for example, professional fees for legal services, property transfer taxes, and other transaction costs. And so this was the initial measurement. An investment property held by a lessee as a right of use asset shall be measured initially at its cost in accordance with IFRS 16. So these are the initial measurement. Then after initial measurement, subsequently International Accounting Standard 40 requires an entity to choose between two models, fair value model or cost model. So whatever policy it chooses should be applied to all of its investment properties. This standard requires all entities to determine the fair value of investment property for the purpose of either measurement if the entity uses the fair value model, or disclose if it uses the cost model. An entity is encouraged but is not required to determine the fair value of the investment property on the basis of a valuation by an independent valuer who holds a recognized and relevant professional qualification and has a recent experience in the location and category of the investment property being valued. When measuring the fair value of investment property in accordance with IFRS 13, an entity shall ensure that the fair value reflects, among other things, rental income from current leases and other assumptions that market participant would use when pricing investment property under current market conditions. When a lessee uses the fair value model to measure an investment property that is held as a right of use asset, it shall measure the right of use asset and not the underlying property at fair value. This means he will measure the right of use asset at fair value, not the underlying property. Okay. Further, as where an entity chooses to classify a property, where an entity chooses to classify where an entity chooses to classify a property held under an operating lease as an investment property, there is no choice. The fair value model must be used for all the entity's investment property, regardless of whether it is owned or leased. After initial recognition, an entity that chooses the fair value model should measure all of its investment property at fair value, except in the extremely rare cases where this cannot be measured reliably. In such cases, it should apply the IAS 16 cost model. A gain or loss arising from a change in the fair value of an investment property should be recognized in net profit or loss for the period in which it arises. Okay. See, this was the first time. Let me have a sip of this coffee. This was the first time that International Accounting Standard Board has allowed a fair value model for non-financial asset. This is not the same as a revaluation, where increases in carrying amount above a cost-based measure are recognized as revaluation surplus. Under the fair value model, all changes in the fair value are recognized in profit or loss. The fair value of an investment property is not reliably measurable on a continuing basis. For example, the market for comparable properties is inactive. For example, there are few recent transactions, price quotations are not current, or observed transaction prices indicate that the seller was forced to sell, and alternative reliable measurement of fair value, for example, based on discounted cash flow projections, are not available. Further, if an entity has previously measured an investment property at fair value, it shall continue to measure the property at fair value until disposal or until the property becomes owner-occupied property or the entity begins to develop the property for subsequent sale in the ordinary course of business, even if comparable market transactions become less frequent or market prices become less readily available. Fair value model. See, the fair value model, the standard elaborates on issues relating to fair value. So we need to consider these issues as well. First is, fair value assumes that an orderly transaction has taken place between the market participant, that is both buyer and seller are reasonably informed about the nature and characteristics of the investment property. A buyer participating in an orderly transaction is motivated but not compelled to buy. A seller participating in an orderly transaction is neither an over-eager nor a forced seller, nor one prepared to sell at any price or to hold out for a price not considered reasonable in the current market. Then is fair value is not the same as the value in use. As defined in IAS 36, impairment of asset, value in use reflects factors and knowledge specific to the entity, while fair value reflects factors and knowledge relevant to the market. In determining fair value, an entity should not double count assets. For example, elevators or air conditioning are often an integral part of the building, should be included in the investment property rather than recognized separately. In those rare cases where the entity cannot determine the fair value of an investment property reliably, the cost model in IAS 16 must be applied until the investment property is disposed of. The residual value must be assumed to be zero. And then there is cost model. Very simple. We learned in IAS 16 investment property should be measured at depreciated cost less any accumulated impairment losses. An entity that chooses the cost model should disclose the fair value of its investment property. Okay, we can take the questions. Mr. Harun, if we have any question, we can answer those questions now.
Mirza Beg is asked, if an investor in Dubai takes a property on rent for 5 years, effective operating lease, and he rents it out to other parties, now is this property investment property? If not, then what to treat in the balance sheet?
If an investor
in Dubai takes a property on rent for 5 years, and rents it out to other parties, now is the property an investment property, or how to treat it in the balance sheet?
Yes, this can be treated as an investment property. This operating lease of the building can be treated as an investment property. Then he will have to apply fair value model. He will have to apply the fair value model for this purpose.
Okay. The next question is from Amir Sikandar, saying, sorry for a bit of a late question. Tell us something on treatment of porter cabins. There are companies who are in business of installing porter cabins on construction sites. These remain there for the project duration, usually more than 2-3 years. They want to show these porter cabins as investment properties, since the definition of building no longer refers to a permanent structure.
See, porter cabins are movable structure. So my professional opinion on this is that this does not fall under the definition of land or building. So maybe at some time in the future, if these quota cabins are developed in a way that these will fulfill the definition of land or building, specifically building, then they will be treated under IAS 40.
Rashid Hanif is saying, Amir Sikandar has just typed this message, sorry, they fall in building definitions now.
If they fall in building definition, then they can be treated as an investment property. If they are for rental or capital appreciation purpose.
Rashid Hanif has given an idea saying, can we have a few sessions on international auditing standards as well, please?
This depends on Mr. Haroon and of course on you people, if you people demand. So
if things can add value, definitely.
Yes.
Tausif Ahmed is saying, kindly send me a video of the lecture. I want this. The video of this lecture and this session is being recorded, and the video will be uploaded on GoToWebinar as well as Vimeo.com after the session. Tausif Ahmed is saying, when we have an investment property that becomes an owner-occupied property, how we value that owner-occupied?
We are going to discuss next. Okay. So this is the cost model. Changing models. Mr. Tasim, I hope these slides will cover your question. Once the entity has chosen the fair value or cost model, it should apply it to all investment property. It should not change from one model to the other unless the change will result in a more appropriate presentation. IAS 40 states that it is highly unlikely that a change from the fair value model to the cost model will result in a more appropriate presentation. Now, transfers. Transfers to or from investment property should only be made when there is a change in use. This is very important. When there is a change in use. Okay. Evidenced by, for example, commencement of owner occupation for a transfer from investment property to owner occupied property, or commencement of development with a view to sale, for a transfer from investment property to inventories, or end of owner occupation for a transfer from owner occupied property to investment property. End of owner occupation means you were occupying this property for the administrative purpose or for the supply of goods or services, but now you have rented it to other parties. So this will become investment property from that date. Or commencement of an operating lease to another party for a transfer from inventories to investment property. So these are the transfers when there is a change in use. This means a property can be investment property in 1 year, but if in the next year if there is a change in its use, then that can be transferred to the owner occupied property or as an inventory, or otherwise an inventory or owner occupied property. If there is a change in use, those properties can be transferred to the investment property. Now let's look at the treatment. What is the treatment for such transfers? First is, if you have an investment property which was being carried at fair value. So please, this slide covers those investment properties which are being carried at fair value. If there is a change in use, so from investment property, this will become the owner-occupied property or inventories, depending upon the type of usage. What is the treatment? The deemed cost for subsequent accounting, fair value at the date of change in use. at the date of change in use, whatever is the fair value of that investment property, that will become the cost for subsequent accounting. This means no entry will be made. That fair value will become the deemed cost. If subsequently it will be treated as an inventory, so that will become the cost of that inventory. If it will be treated as a owner-occupied property, then this will become the cost for that owner-occupied property. Okay. The second red one is if a property is an owner-occupied property and being treated under IAS 16 or IFRS 16, and it has become investment property, which will be carried at fair value. So that's why I mentioned on the top fair value, which will be carried. Here, transfer is from investment property, which is being carried at fair value. Here, inventories or owner-occupied property is being transferred to investment property, and that investment property will be carried at fair value. So the difference between the value under these old standard at the date of change and fair value, because at that date you need to determine the fair value, because from that point this will be measured at fair value. So the difference between its carrying value and the fair value on the date of change, this will be treated as a revaluation in accordance with IAS 16. This may be difficult to absorb, but anyway, I have an illustration to explain this second point, and the solution is included in that. A business owns a building which it has been using as a head office. In order to reduce cost, on 30th June 2009, it moved its head office function to one of its production centers and is now letting its head office. Company policy is to use the fair value model for investment property. The building had an original cost on 1st January 2020, 250,000, and was being depreciated over 50 years. At 31st December 2009, its fair value was judged to be 350. How will this appear in the financial statement at 31st December 2009? The building, first you will be calculating the carrying amount on the date of change in use. See, this was the cost. Let me use the pen. This was the cost. This was the depreciation till the date of change in use. So this was the carrying amount. As we saw in our previous slide, we say, okay, the difference between the value. So this is the value. 202,500. This is the value. And revaluation surplus and the fair value. This is the fair value, 340. We can see from here 202,500, 202,500. This is the value under IAS 16. And what is the fair value? 350,000. The difference between these two amounts will be treated as a revaluation. So if we go back, so this is the revaluation surplus. Okay, comes to the next slide. So let me use the normal non-drawing mode. Okay, we are on 40. Resume. Then is from inventories. A property was held as an inventory. So this is transferred to the investment property, and that investment property will be carried at fair value. That investment property will be carried at fair value. So the difference between the value under IAS 2 at the date of change and the fair value of that investment shall be recognized in profit and loss. But when an entity completes the construction or development of a self-constructed investment property, that will be carried at fair value. Any difference between the fair value of the property at the date and its previous carrying amount shall be recognized in profit and loss. Next is when an entity, in case of cost model, if an entity using cost model for investment property, so transfers between investment property, owner occupied property and inventories do not change the carrying amount of the property transferred, as they do not change the cost of that property for measurement or disclosure purposes. And in case of disposal, very simple, de-recognize an investment property on disposal, or when it is permanently withdrawn from use or no future economic benefits are expected from its use. Any gain or loss on disposal is the difference between the net disposal proceeds and the carrying amount of the asset. It should generally be recognized as income or expense in the profit and loss account. Again, this thank you does not mean that we are ending. We are moving to another standard, and that standard is International Accounting Standard 36. If we have any question, I can answer at this point in time, but very briefly.
Yeah, all right. There are 3 or 4 questions. Hamdullah Hussain is saying, owner leases the building and subsequently the lessee subleases the building. Kindly explain the implication.
Again, please.
Owner leases the building and subsequently the lessee subleases the building.
So I explained it earlier that this is the, if it is an operating lease, that can be treated as an investment property.
Okay. Then the question is it possible for a company to use both cost and fair value models on different class of properties?
Yes, it is possible. It is possible, but that is related to the company financial institutions. That relates to the financial institution. There is a possibility in like investment property backed liabilities. There you can use 2 different types of models.
Okay, Sayyid Shah is asking, I'm not clear in operating lease aspect of both lessee and lessor. Please repeat.
Lessee and lessor. Okay, please see the recording. I have, and it is very well covered in slides.
Okay, Togro Salman is saying, by when is this session scheduled to end? I think in another 50 minutes, 50. Muhammad Zunur Khaja is saying, if a property is made with intentions to sell, but due to market condition owner decides to rent it out till market gets better, then under what IAS will you can treat this property?
Of course, see, if a building is constructed for the purpose of sale, this will be treated under ISA 2. But subsequently, if they decide that they will be renting, once in fact they rent it, so then from that date this will become investment property.
Tausif Ahmed is saying transfer FV model, and second point, if there is no FV at all at that time, can we use the depreciated cost of property?
Which model, Tausif, please?
Transfers FV model, second point.
Second point, this one? Tausif, can you see this slide? Are you talking about this slide or the previous slide? Okay.
He's not answering. The previous one.
Okay, the previous slide. Okay, now ask the question, please. To see what is your question? Yes, please repeat the question.
The question is transfers FV model.
Okay.
Second point, if there is no FV at that time, can we use the depreciated cost of property? If there is no.
So that will become Tausif cost model, and we have just seen within cost model, no difference will arise.
Okay, Muhammad Amin is saying it's namaz time in Karachi. Amin, we've already taken the namaz break. You can please go on and say your prayers, and this is your back.
You can watch the recording.
You can watch the recording. We're answering questions in the meanwhile, so it should not be too much. Second Shah is saying, what about if there was a revaluation surplus when moving from owner to investment under FV? Do we need to transfer all through P?
All through?
All through P&L?
Revaluation surplus?
Yeah.
See, for revaluation surplus, IAS 16 will be applicable. So you have the option to transfer revaluation surplus to the profit and loss account, or on disposal of that asset, you can transfer that revaluation surplus to the retained earnings.
Okay. The next question is from Rana Hafiz. He's saying, any illustration of cost model, please?
See, Rana Hafiz, cost model is very simple. If you just look at it, cost model is simple. There is no change. There is no difference between the figures before the change and after the change. So no entry will be made. So there is no need of illustration.
Zunur and Khaja is saying, can we have a section in detail on consolidation?
Of course, if most of the members require it, we can have it.
Muhammad Imran is saying, new standard IFRS 16 only allow finance lease.
Who is
Muhammad Imran.
Muhammad Imran. Muhammad Imran, for lesser, IFRS 16 allows both operating and finance leases. And for lessee, when we are talking about investment property, this means an entity owns a property and is renting to other parties. So this is operating lease and the entity is a lessor. IFRS 16 has retained this classification, so that's why I'm using that.
Okay, Mr. Beg is saying for operating lease, it's not recorded in balance sheet. Then how we can treat it?
Mr. Beg, when you will apply IAS 40 to an operating lease, then IAS 40 says you will have to treat that, you will have to apply finance leases treatment to this operating lease.
Toxie family is saying, can we have previous lectures videos? Yes, they've been uploaded. Tolu Salman's last question.
Okay,
what would be the accounting part of a building not separately saleable if it is rented out?
If it is not separately saleable, see which portion is significant. If rental portion is significant, then the whole building will be treated as an investment property. If the owner-occupied portion is significant, then the whole building will be treated as a owner-occupied. I think we should move.
Yeah.
Okay. Now, International Accounting Standard 36. International Accounting Standard 36, impairment. Impairment of assets. So, ISO 36 applies. Let me open it over here as well so that it should be in front of me. Because I mentioned the screen is on my right.
I can help you with that.
No problem. Next time we will take care that it is better, it should be in front of me. Okay. ISO 36 applies to all tangible, intangible, and financial assets, except inventories, asset arising from construction contracts, deferred taxes, deferred tax assets, asset arising under ISO 19, employee benefits, and financial assets within the scope of ISO 32, financial instruments presentation. This is because those ISAs already have rules for recognizing and measuring impairment. Note also that ISO 36 does not apply to non-current asset held for sale, which are dealt with under IFRS 5. Next is impairment. Impairment is basically a fall in value of an asset so that its recoverable amount is no less than its carrying amount in the statement of financial position. An asset is impaired if its recoverable amount is higher than its carrying amount. So the difference between the recoverable amount and the carrying amount, as we know, is the impairment. Carrying amount, the net value at which the asset is included in the statement of financial position. So we will explore these three issues. How is it possible to identify when an impairment loss may have occurred? How should the recoverable amount of the asset be made? And how should an impairment loss be reported in the accounts? First question, an entity should assess at the end of each reporting period whether there are any indications of impairment to any assets. The concept of materiality applies, and only material impairment needs to be identified. If there are indications of possible impairment, the entity is required to make a formal estimate of the recoverable amount of the assets concerned. ISO 36 suggests how indication of a possible impairment of assets might be recognized. the suggestions are based largely on common sense. For example, external sources of information include like a fall in the asset's value in the open market that is more significant that would normally be expected from passage of time over normal use, like because of technological obsolescence or because of some competitor, uh, because of some competitors, competition in the market, a significant change in the technological, market, legal, or economic environment of the business in which the assets are employed, an increase in market interest rate or market rate of return on investment likely to affect the discount rate used in calculating value in use. Because the recoverable amount, we know higher of value in use and the fair value less disposal cost. So in the calculation of the value in use, we need interest rate for the purpose of discounting the future cash flows. So if there is a significant change in the interest rate, so this is also an indication that the asset may be impaired. The carrying amount of the entity's net asset being more than its market capitalization. Next is some internal indications. Some internal indications like evidence of obsolescence or physical damage, adverse changes in the use to which the asset is put. For example, one of the leading cement manufacturer in the world, we found that in one region where they were working and we were auditing their accounts. So in that particular region, that country started local production of the cement. So their sale dropped drastically, and there was a question mark on their going concern. So because the asset related to the cement production, of course, this is an indication. This is an external indication that now you need to check those assets for impairment, because these assets were being used for the production of the cement, and there was a drastic change in the market resulting in the drastic reduction in the sale for the time to come. Even if there are no indications of impairment, the following asset must always be tested for impairment annually. So one is an intangible asset with an indefinite useful life, other is goodwill acquired in a business combination. Then is the recoverable amount. As we know, this is the higher of assets fair value less cost of disposal and its value in use. What is assets fair value less cost of disposal? Is the price that would be received to sell the asset in an orderly transaction between the market participant at the payment date less the direct disposal costs such as legal expenses. If there is an active market in the asset, the fair value should be based on the market price or on the price of recent transaction in similar assets. If there is no active market in the asset, it might be possible to estimate fair value using best estimate of what market participant might pay in an orderly transactions. Fair value less cost of disposal cannot be reduced, however, by including within cost of disposal any restructuring or reorganization expenses or any costs that have already been recognized in the accounts as a liability. And then is the value in use. Value in use of an asset is measured as the present value of estimated future cash flows, inflows minus outflows generated by the asset, including its estimated net disposal value at the end of its expected useful life. So now, what is the treatment? How shall we recognize and measure the impairment loss? We know what is the impairment loss. This is the difference between the carrying amount and the recoverable amount. When recoverable amount is higher than the carrying amount, the difference is the impairment loss. How will we recognize for asset at historical cost? Mean for asset where we apply cost model under IAS 16, if the recoverable amount of the asset is lower than the carrying amount, the carrying amount should be reduced by the difference, mean that is the impairment loss, which should be charged as an expense in profit or loss. Here it is written profit, please make it profit or loss. The rule for asset held at a revalued amount, such as property revalued under IAS 16, the impairment loss means the difference between the carrying amount and the recoverable amount shall be treated as revaluation decrease under the relevant IAS. In practice, this means to the extent that there is a revaluation surplus held in respect of the asset, the impairment loss should be charged to the revaluation surplus, and any excess should be charged to the profit and loss account. But when it is not possible to calculate the recoverable amount, but before moving further, I would like to highlight, simply remember this will be treated as a revaluation decrease, and all those requirements for revaluation decrease which we learned under IAS 16 will be applicable to this impairment loss. Then there is a concept, as we learned in earlier studies, that sometimes it is not possible to calculate the recoverable amount of an asset. So then you should club that asset with a group of assets, and that group of asset which generates cash flow largely independent. For example, if you have a machine and there is a big fan for keeping that machine cool, for the cooling purpose of that machine, but that fan is not used in routine. Its size and its shape is of special type which is required for cooling of the machine which is being used by your organization. So that fan cannot be sold in the open market, or that fan will not be having an open market value except as a scrap. And likewise, that fan is not generating any cash flows. Then that fan will be clubbed with that machine. So this small group of assets will generate cash flows which are independent of the other cash generating units. So this means any asset whose recoverable amount cannot be determined independently, club that asset with other assets and such group of assets which could generate cash flows largely independently. So when it is not possible to calculate the recoverable amount of single asset, then that of its cash generating unit should be measured instead. A cash generating unit is the smallest identifiable group of assets for which independent cash flows can be identified and measured. Examples, for example, a mining company owns a private railway that it uses to transport output from one of its mines. The railway now has no market value other than a scrap, and it is impossible to identify any scrap separate cash inflows with the use of the railway itself. Consequently, if the mining company suspects an impairment in the value of the railway, it should treat the mine as a whole as a cash generating unit and measure the recoverable amount of the mine as a whole. Another example is a bus company has an arrangement with the town's authority to run a bus service on 4 routes in the town. Separately identifiable assets are allocated to each of the bus routes, and cash inflows and outflows can be attributed to each individual route. 3 routes are running at a profit and 1 is running at a loss. The bus company suspects that there is an impairment of assets on the loss-making route. However, the company will be unable to close the loss-making route because it is under an obligation to operate all 4 routes as part of its contract with the local authority. Consequently, the company should treat all 4 bus routes together as a cash generating unit and calculate the recoverable amount for the unit as a whole. That single route cannot be treated as a cash generating unit because running of that single route is dependent on the running of the rest of the 3 routes. So its cash flow are not independent of the other routes. So that's why all the 4 routes will be treated as a single cash generating unit. If we have any doubt about the impairment on a single room, we will have to calculate the recoverable amount of all the 4 units and compare it with the carrying amount of cumulative carrying amount of all the 4 routes in order to decide about the impairment of the 4 routes. Another example is Minimart belongs to a retail store chain, Maximart. Minimart makes all its retail purchases through Maximart Purchasing Center. Pricing, marketing, advertising, and human resources policies, except for hiring Minimart's cashiers and salesmen, are decided by the Maximart. Maximart also owns 5 other stores in the same city as Minimart, although in different neighborhoods, and 20 other stores in other cities. All stores are managed in the same way as Minimart. Minimart and 4 other stores were purchased 5 years ago and goodwill was recognized. All Maximart stores are in different neighborhoods and probably have different customer bases. So although Minimart is managed at a corporate level, Minimart generates cash inflows that are largely independent from those of Maximart. This means the decision factor is whether that unit generates cash flow that are largely independent from the other units, then that will become the cash generating unit. So it is not the decision factor that whether how it is being operated, how it is being managed. This is not the decision factor. The decision factor is that its cash flow should be largely independent from other units. Next is few more points in this regard. If an active market exists for the output produced by the asset or a group of assets, this asset or group of assets should be identified as a cash generating unit, even if some or all of the output is used internally. This means, in fact, that unit should be capable of generating cash flows which are largely independent. Whether it is doing currently those cash flows or not, that does not matter. It should have the capability of generating largely independent cash flows. Second is cash generating units should be identified consistently from period to period for the same type of asset unless a change is justified. The group of net assets less liability that are considered for impairment should be the same as those considered in the calculation of the recoverable amount. Okay. Next is allocating the goodwill to the cash generating unit. Goodwill acquired in a business combination does not generate cash flows independently of other assets. It must be allocated to each of the acquirer's cash generating units or groups of cash generating units that is expected to benefit from the synergies of the combination. Each unit to which the goodwill is so allocated should represent the lowest level within the entity at which the goodwill is monitored for internal management purposes, not be larger than a reporting segment determined in accordance with IFRS 8 operating segment. So this is an example, and a couple of more examples, small examples, which will be used in order to explain the points in the slide we have just covered. So this is the first example. A cash generating unit comprises the following: C building, plant and equipment carrying amount 6 million, goodwill 10 million, current assets 20 million. If you people have any question, please don't ask at this point in time. I am very confident that the examples to come will answer most of your questions. Anyway, if any question is unanswered, then I will announce, please ask that question again. Okay, so goodwill 10 million, current assets 20 million, so 66 million is the carrying amount of this cash generating unit. Following a recession, an impairment review has estimated the recoverable amount of the cash generating unit to be 50 million. How do we allocate the impairment loss? First, we calculate the impairment loss. The impairment loss is, let me have pen from here. Okay. See, this is the carrying amount and this is the recoverable amount. The difference between these two is 16 million. So this is the impairment loss. Now we shall allocate this impairment loss to these assets. First of all, goodwill will disappear. But goodwill amounting to 10 million, but our loss is 16 million. What about the 6 million remaining impairment loss? This will be allocated between these two amounts in the ratio of their carrying amount. If we calculate the total of these two assets, this comes to 36. So this 6 million will be allocated to the building in the ratio of 30 by 36 and to plant and building in the ratio of 60 by 36. So this is the answer. Here you can see that we have allocated 10 million to the goodwill. Whole is gone. Finish. But our impairment loss, means this is the first one. Remaining 6 million is allocated to building and plant and equipment. This will not be allocated to the current asset, as we have seen right at the start under the heading of scope, that current inventories and other assets will be dealt according to IAS 2 or other standard, any impairment within those. So this impairment will be allocated to building and plant and equipment. Okay, this was the first example. Next is, let me convert it to the normal mode. Do this from here. From here, to the normal mode. It is not working. Let me try again. Hopefully, I find some solution. Okay, normal mode. So this was the first. Then there are a few more examples, but before those examples, for individual asset, we know that we will reduce the carrying amount of that asset. So subsequently, depreciation will be charged on the basis of the carrying amount after allocation of impairment loss. And for cash generating unit, an impairment loss should be recognized for a cash generating unit if and only if the recoverable amount for the cash generating unit is less than the carrying amount in the statement of financial position for all the assets in unit. When an impairment loss is recognized for a cash generating unit, the loss should be allocated between the asset in the unit in the following order. So this is the order. First to any asset that are obviously damaged. This is the first. Next to the goodwill. If impairment loss is not fully treated, any remaining amount will then to all other assets in the cash generating unit on a pro rata basis. But remember, while following this these steps, remember, in allocating an impairment loss, the carrying amount of an asset should not be reduced below the highest of its fair value less cost of disposal, its value in use if determinable 0. You cannot make an asset negative after allocation of impairment loss. So let's see it with the help of an example. A company that extracts natural gas and oil has a drilling platform in Caspian Sea. It is required by legislation of the country concerned to remove and dismantle the platform at the end of its useful life. Accordingly, the company has included an amount in its accounts for removal and dismantling cost and is depreciating this amount over the platform expected life. The company is carrying out an exercise to establish whether there has been an impairment of the platform. See, its carrying amount is 3 million. Carrying amount is 3 million. The company has received an offer of 2.8 million for the platform from another oil company. The bidder would take over the responsibility for dismantling and removing the platform at the end of its life. The present value of the estimated cash flow from the platform continued use is 3.3 million. This is value before adjusting for dismantling costs. So this means we will adjust dismantling cost within this 3.3. The carrying amount in the statement of financial position for the provision for dismantling and removal is 0.6 million. What should be the value of the drilling? First of all, we will calculate its recoverable amount, which is higher of value in use less disposal, cost of disposal, and value in use. Okay, let's move to its answer, which is on the other slide. See, this is the fair value less cost of disposal, 2.8, because the platform that bidder would take over the responsibility and cost for dismantling and removing the platform at the end of its life. So this is fair value less cost of disposal. 2.8, value in use, present value of the cash flow from use less the carrying amount of the provision. 3.3 minus 0.6, so this will give you 2.7. So the lower amount is higher of these two is 2.8. So this is the recoverable amount, 2.8. Carrying amount is 3 million. So this is the impairment loss. Though I am not taking your question, but these questions and examples are written in such a way that when you will see its recording, you will easily be able to appreciate the concept. The carrying value should be reduced to 2.8. Another question is, a company has acquired another business for 4.5 million. Tangible assets are valued at 4 million and goodwill at 0.5. An asset with a carrying value of 1 million is destroyed in a terrorist attack. The asset was not insured. The loss of the asset without insurance has prompted the company to assess whether there has been an impairment of asset in the acquired business and what the amount of any such losses. The recoverable amount of the business, a single cash generating unit, is measured at 3.1 million. So what is the answer for this? See, there has been an impairment, loss of 1.4 million, because this is the difference between its carrying value, which is 4.5, and the recoverable amount, which is 3.1. The impairment loss will be recognized in profit or loss. The loss will be allocated between the asset and cash generating unit as follows. As I gave you the principle earlier in earlier slide, that a loss of 1 million can be attributed directly to the uninsured asset that has been destroyed. Simply, your total loss is 1.4, so the asset destroyed 1 million will go to that asset. Okay, 0.4 million will go to your goodwill. Your total goodwill is 0.5 million. So when we will charge 0.4 million to the goodwill, the whole impairment loss will be allocated. The carrying amount of the asset will now be 3 million for the tangible asset and 0.1 million for the goodwill. So this is the accounting treatment with the help of an example. Further, reversal of impairment loss. I shall be explaining it also with a help of a small example. So when you will see the recording, you will be very easily able to appreciate this. However, if we have a couple of minutes at the end, I'll be welcoming your questions. An annual assessment to determine whether there may have been some impairment should be applied to all assets, including assets that have already been impaired in the past. There might have been a reversal of some of the previous impairment loss. The reversal of impairment loss should be recognized immediately as income in profit or loss. The carrying amount of the asset should be increased to its new recovery level. However, an exception to this rule is for goodwill. An impairment loss for goodwill should not be reversed in a subsequent period. So let's see with the help of an example. Example is a cash generating unit comprising a factory, plant and equipment, etc. And associated purchased goodwill becomes impaired because the product it makes is overtaken by a technologically more advanced model produced by a competitor. The recoverable amount of the cash generating unit falls to 60 million, resulting in an impairment loss of 80 million, allocated as follows. You allocated the loss like 60, how much was the impairment loss? 80. 80 was allocated like 40 to the carrying amount before impairment, carrying amount after. So 40 million was allocated to the goodwill, 20 million was allocated to the payment because it has no market value, and the remaining 20 million was allocated to the tangible non-current assets. So 40 becomes 0, 20 becomes 0, 80 becomes 60. So carrying amount after impairment becomes 60 million. After 3 years, the entity makes a technological breakthrough of its own, and the recoverable amount of the cash generating unit increases to 90 million. The carrying amount of the tangible non-current asset, had the impairment not occurred, would have been 70 million. Calculate the reversal of the impairment loss. Apparently, reversal is equal to 20 million. The difference between, the difference between 30 million, between 90 and 60 million. Oops. The reversal of the impairment loss is recognized to the extent it increases the carrying amount of the tangible non-current asset to what it would have been had the impairment not taken place. That is, a reversal of the impairment loss of 10 million is recognized and the tangible non-current asset written back to 70 million. Reversal of the impairment loss is not recognized in relation to the goodwill and patent because the effect of the external event that caused the original impairment and not reversed the original product is still overtaken by a more advanced model. What we learned from this? We learned, in fact, see, had there been no impairment, the carrying amount of the asset would have been 70 million. While reversing this 60 million, remember, you cannot increase these tangible non-current assets beyond this amount. So your tangible non-current asset will be reversed by 10 million, and the 20 million of impairment will not be recognized. And we will not be reversing impairment related to the goodwill and the patent. So this was International Accounting Standard 36. I have 5 minutes to answer your question if you have any, but if you yourself can decide if you can learn something or revise something by watching the recording, then please don't ask that question.
Okay. There are a few questions, so I should go in sequence. Some of these were posted before the last session that we had. Mohammed Imran was saying Microsoft Office license is an intangible asset, and how would we recognize as God license for the next version?
This relates to the next standard.
Mohammed Imran is saying if the entity is not interested in new versions, then it would be every year assessed, and how we amortize it. Means MS Windows and MS Office license fee.
This again
the same question. Zishan Qureshi is saying if the company is required by local authorities to move its plant to another location, it will be treated under IAS 36 or another standard?
This transfer from one location to another location.
Move its plant to another location.
So, what are the financial implications of this movement? If you mean that the expense incurred of this transfer, so that will be recognized in profit and loss.
Okay, Nasser is saying why it is important to test intangible assets for annual impairment, and what are the factors in this area from which we can assess impairment.
See, this is not unconditional. There is a condition. See, if an intangible asset with an indefinite useful life, when you recognize that intangible asset, you assume that, or you assume that this intangible asset will have indefinite life. So, only in that case, you need to reassess every year.
Nasser Ali is saying, why is it important to test intangible assets on annual impairment? What are the factors in this area? I think we've asked this question. Hussain Abdullah is saying, what if impairment loss is less than goodwill carrying amount?
Goodwill carrying amounts, the whole impairment will be absorbed in the
Najam is saying, kindly send the recording of this webinar. Najam, the recording will be uploaded by tomorrow evening, because that's the time it takes go to webinar to process the video. Nuza Al-Riyami is saying, how can we use impairment for financial assets, equity, bonds?
Hopefully, we will be discussing under financial instruments in the coming sessions.
Tausif Ahmed is saying, from which...
See, the principle is very simple. If impairment, how to treat impairment loss, if it is not discussed in any particular standard, then 36 will be applicable.
Tausif Ahmed is saying, which website can we get the videos from? I'll make an announcement formally also, but this is vimeo.com/ACCA Pakistan. I'll just send it in a message to all of you. Rashid Hanif is saying, double entry of reverse of impairment in last example. If you can repeat this.
Double entry that you will be accounting reversal. This is the reversal. Yes, this reversal. So you will be debiting your asset. So you will be debiting your asset and crediting asset and crediting profit and loss in case of cost model. In case of revaluation model, you will be treating it as a reversal of previous deficit. To the extent it reverses the previous deficit, recognize it in the profit and loss account, and any excess should be treated as revaluation surplus.
Nasser Ali's last comment is saying, brilliant. Thank you.
Thank you very much, Nasser Ali. It encourages us to do more sessions and produce more material. Now, the last standard is International Accounting Standard 38.
And you've got about 10 minutes left.
No problem. Because right at the start I mentioned I'll be going through this standard very quickly, because this standard requires a lot of discussion. There are many aspects of this standard, and each aspect can be discussed for many hours. Each aspect can be discussed, so we'll be very brief. So here in this case, in case of IAS 38, if you have any question unanswered, of course I will not be taking any question, but anyway, if I finish by 15 minutes, so then we can have 5 minutes for answering. Okay, we don't have. Okay, so you can send me, you can email me, I'll be happy to answer that. Though we have abandoned this policy to answer question this way, because last time we received more than 800 questions, so that is not manageable to answer those questions. So that's why we are answering as we go. Anyway, International Accounting Standard 38. International Accounting Standard 38 Intangible assets.
Ishan is saying too many ISAs and IFRS in one session.
Yes, you're very right. It is challenging as well. Anyway, ISA 38 intangible asset. Of course, the objective of the standard is to establish the criteria when an intangible asset may or should be recognized, to specify how intangible assets should be measured, and to specify the disclosure requirements. Definition of an intangible assets. The key aspect of the standard is whether or not an intangible asset may be recognized in the accounts of an entity are based on the definition of what an intangible asset is. See, an intangible asset is an identifiable non-monetary asset without physical substance. The asset must be controlled by the entity as a result of events in the past, and something from which the entity expects future economic benefits to flow. Examples of items that might be considered as intangible assets include computer software, patents, copyrights, motion picture films, and customer lists, franchises, and fishing rights. An item should not be recognized as an intangible asset, however, unless it fully meets the definition in the standard. Okay. Intangible asset, of course, it must be identifiable and controlled by the entity, otherwise an entity should expect future economic benefits. Management has to exercise its judgment in assessing the degree of certainty attached to the flow of economic benefits to the entity. External evidence is best. If an intangible asset is acquired separately, its cost can usually be measured reliably as its purchase price, including incidental cost of purchase such as legal fee and any cost incurred in getting the asset ready for use. When an intangible asset is acquired as part of a business combination, an acquisition or takeover, the cost of the intangible asset is its fair value at the date of acquisition. IFRS 3 explains that the fair value of the intangible asset acquired in a business combination can normally be measured with sufficient reliability to be recognized separately from goodwill. If you can measure that intangible asset acquired in a business combination sufficiently reliably, only then you should recognize that intangible asset. Otherwise, this will become the part of the goodwill. Quoted market prices in an active market provide the most reliable estimate of the fair value of an intangible asset. If no active market exists for an intangible asset, its fair value is the amount that the entity would have paid for the asset at the acquisition date in an orderly transaction between market participants on the basis of the best information available. In determining this amount, an entity should consider the outcome of recent transactions for similar assets. There are techniques for estimating the fair values of unique intangible assets, such as brand names, and these may be used to measure an intangible asset acquired in a business combination. In fact, using financial management techniques, in accordance with IAS 20, intangible asset acquired by way of government grants and the grant itself may be recorded initially either at cost, which may be zero, or fair value. Exchange of assets and will follow the same principle as we learned under ISA 16. Then there are internally generated intangible assets. Please remember, internally generated goodwill may not be recognized as an asset. Like if you are carrying out a business for last 20 years, this business might have a goodwill which is created over a period of 20 years, but you are not allowed to recognize this goodwill. The standard deliberately precludes recognition of internally generated goodwill because it requires that for initial recognition, the cost of the asset rather than its fair value should be capable of being measured reliably, and that it should be identifiable and controlled. Thus, you do not recognize an asset which is subjective and cannot be measured reliably. Research and development costs. Development cost can be recognized as an asset. We know that research cost will be expensed out, that cannot be capitalized. However, development cost can be recognized as an asset if it meets certain criteria given in the standard. These are the examples of the research cost, activities aimed at obtaining new knowledge, and there are other examples. So an organization will recognize the research cost as an expense during the period in which it incurs. Development cost may qualify for recognition as intangible assets, provided that the following strict criteria can be demonstrated. The technical feasibility of completing the intangible asset so that it will be available for use or sale. Its intention to complete the intangible asset and use or sell it. Its ability to use or sell the intangible asset. How the intangible asset will generate probable future economic benefits. Among other things, the entity should demonstrate the existence of a market for the output of the intangible asset or the intangible asset itself, or if it is to be used internally, the usefulness of the intangible asset. Its ability to measure the expenditure attributable to the intangible asset during its development reliably. If all these conditions are being met, then you can capitalize that development expenditure. In contrast, with research cost, development costs are incurred at a later stage in a project, and the probability of success should be more apparent. And these are a few examples of the development cost. Other internally generated intangible asset, we learned about goodwill. We learned that we cannot recognize internally generated goodwill. And for the other intangible asset, the standard prohibits the recognition of internally generated brands, mastheads, publishing titles, and customer lists, and similar items as intangible asset. These all fail to meet one or more, in some cases, all the definition and recognition criteria, and in some cases are probably indistinguishable from internally generated goodwill. However, cost of an internally generated intangible asset should be initially measured at cost, but subsequently they can be carried at cost or at a revalued amount. Then is revaluation model. See, measurement of intangible assets subsequent to initial recognition. The standard allows two methods of valuation for intangible assets after they have been first recognized. Applying cost model, an intangible asset should be carried at its cost, less any accumulated amortization, and less any accumulated impairment losses. And there are certain guidelines for the calculation of the fair value at the date of revaluation, and this should be, preferably it should be based on active market. The entire class of intangible asset of that type must be revalued at the same time, and if an intangible asset in a class of revalued intangible asset cannot be revalued because there is no active market for this asset, the asset should be carried at cost, less any accumulated amortization and impairment loss. Further, revaluation should be made with such regularity that the carrying amount does not differ from that which would be determined using fair value at the end of the reporting period. This treatment is not available for initial recognition of intangible assets. This is because the cost of the asset must be measured reliably. The guideline states that there will not usually be an active market in an intangible asset. Therefore, the revaluation model will usually not be available. For example, although copyrights, publishing rights, and film rights can be sold, each has a unique sale value. In such cases, revaluation to fair value would be inappropriate. A fair value might be obtainable, however, for assets such as fishing rights or quotas or taxi cab licenses. Where an intangible asset is revalued upward to a fair value, the amount of the revaluation should be credited directly to equity under the heading of the revaluation surplus. However, if a revaluation surplus is a reversal of a revaluation decrease that was previously charged against income, the increase can be recognized as income. When the carrying amount of an intangible asset is revalued downward, the amount of the downward is same principle as we learned in case of ISA 16. Okay, let's see useful life. An entity should assess the useful life of an intangible asset, which may be finite or indefinite. An intangible asset has an indefinite useful life and there is no foreseeable limit to the period over which the asset is expected to generate net cash inflows for the entity. Many factors are considered in determining the useful life of an intangible assets, which include expected usage, typical product life cycles, technological obsolescence, and other factors. Computer softwares and many other intangible assets normally have short lives because they are susceptible to technological obsolescence. However, uncertainty does not justify choosing a life that is unrealistically short. The useful life of an intangible asset that arises from contractual or other legal rights should not exceed the period of the rights, but may be shorter depending on the period over which the entity expects to use the asset. Amortization period and amortization method. An intangible asset with a finite useful life should be amortized over its expected useful life. Amortization should start when the asset is available for use, and amortization should cease at the earlier of the date the asset is classified as held for sale in accordance with IFRS 5 and for sale. Then the amortization method should reflect the pattern in which the asset future economic benefits are consumed. The residual value of intangible asset with a finite useful life is assumed to be zero unless a third party is committed to buying the intangible asset at the end of its useful life, or unless there is an active market for that type of asset. Similarly, intangible assets with indefinite useful life and intangible asset with an indefinite useful life should not be amortized, but you need to assess its recoverable amount every year, as we learned in ISA 36. Disposal retirements of intangible assets. An intangible asset should be eliminated from the statement of financial position when it is disposed of, and when there is no further expected economic benefits from its future use. On disposal, the gain or loss from the difference between the net disposal proceeds and the carrying amount of the asset should be taken to the profit and loss account. Then there are requirements related to the IFRS 3. How will you be recognizing goodwill? Because goodwill is an intangible asset, but this goodwill is purchased goodwill, so you can recognize it. Earlier we discussed internally generated goodwill, that is not allowed, but this goodwill is purchased goodwill, and as a result of business combination, there is any surplus that will be a purchased goodwill. So accordingly, you will be recognizing as per these guidelines related to the business combinations. So these are the slides related to those goodwills. And I'm really sorry for running or for skipping through material, but why I kept it at the end, because I know we are very comfortable. Most of the people are very comfortable with ISA 38. Anyhow, if you have any question, because it has very clear guidelines. However, if you have any specific question, so you can ask now. If we have 2-3 minutes left.
We've run over, and there are some members were saying.
Okay. Okay. So you can email me if you have specific question. I'll be happy to answer those email, but only related to ISA 38, because we have taken sufficient time to answer. We have taken sufficient time to answer those questions. My email address is mentioned over here. This is one email address. Another email address is abubakar@baker. So I included one email address in the footer. So space was not sufficient anymore for writing another email address. So this is my another email address, Baker, BAKERTILLYFIQ.com. So you can write me a question related to the ISA 38. And thank you very much. And over to Mr. Harun if he wants to say something.
I think that's all about it. I had those two usual questions of where are you attending this session from and what's your feedback. So if you can quickly have those poll questions.
Yes, please.
So I'll just very quickly, it not take more than 2 seconds, and not 2 seconds, 2 minutes. So very quickly pop those questions up and I need your answers. So on your screens, if you can see the question on where are you from. So if you can very quickly answer this question. Well, this time we had people from Sri Lanka as well. Okay. 30 more seconds. All right, that's it. That's my first question. The second question is about your feedback. So it comes on your screen now. How did you find today's session? About 30 seconds to go. Brilliant, thank you very much. I'm just going to share the results with all of you as well. So this time, 26% people said this was excellent, 56% said this was very useful, and 17% said this was good. There were no below average marks and there were no indifferent marks.
Thank you very much.
Thank you very much. Thank you very much, ladies and gentlemen, for your participation. Let me announce that now the topic on accounting for fixed assets is over. We will now be issuing the certificates by tomorrow. And our tomorrow's session, for those who are participating in it, starts at 1 p.m. Pakistan time and it finishes at about 5 p.m. So it's another 4-hour session. So you can check your local time and join accordingly. The invite will probably go to webinars invite will give you the exact local time for this session. Looking forward to seeing most of you tomorrow as well. Thank you very much. Take good care of yourself. And those who will not be joining us tomorrow, have a good weekend. Thank you very much.